Hi everyone, how are you all? I'm sure your preparations are going great. So the energy levels are super duper high. Excitement levels for this PM revision is also very high. I am assuming it. Now, all of you, quickly, I just want one revert in the chat box. Can you hear me properly? There is no issue with the audibilities. There is no issue with the video. Please put that in the chat box quickly. Okay, so now on that note, let's start with a PM revision. So here on my screen, you can see my plan, the plan that we will be following for doing our revisions. So your topics, I will be covering 100% of your PM topics will be covered live here. Okay, for the revision sessions. Now, thank you, Moksha. Now, day one, that is today, the plan is, thank you, Anjali. Okay, so day one, the plan is that we will be covering topics throughput, environmental and sustainability, target and life cycle costing, relevant costing, limiting factor analysis, pricing decisions, risk and uncertainty, and quantitative analysis. These are the topics that we are going to be covering today. Tomorrow, the plan is to cover topics budgets, including the budgetary systems, variances, performance analysis and measurement, ABC and absorption costing, data, information, the information systems, data analytics, big data, divisional performance and transfer pricing. So this is the planner that we are going to be following for today and tomorrow. Now, let's start with our first topic. And also people, I'm giving you one leverage. When whatever topics I'm going to be covering, the chapters when I'm covering, you have any doubts, any queries in that chapter that has been troubling you, you can put that freely in the chat box, and of course I will be taking up that question. I'll be taking up your query, your concern, and would be resolving it, so that by the time that we finish with our revisions, you're 100% crystal clear with your topics, with your your queries, and absolutely you're confident to appear for your PM exams. So now everybody keep following, keep typing, and show your support. And before we please move ahead, don't forget to like the video, subscribe it, share it with your friends so that more and more people can join and can benefit from this session. Now, let's start with the first topic. First topic that I'm taking up is throughput accounting. So let's take throughput accounting. So this is the first topic that I'm going to take with an elaborate understanding. Okay. Now, one thing is there, guys, parallelly that we are doing this revision, let me remind you, I have already conducted and then uploaded also section A and B marathon for PM subject, wherein around 130 questions I took it in the class. Apart from this, I have also uploaded more content for section C also on the PM subject. Now that is there in my PM playlist. So in case if you have not gone through it, do go through it so that your revisions with your question practice becomes a complete, complete information that you need in order to ensure that you have confidence levels super high. Okay, so let's take a throughput. Okay, now let's start with this. What is throughput? We know that typically in absorption costing environment, the aim of the entity is to maximize profits. In a marginal costing environment, the aim is to maximize contribution. But when it comes to throughput, in the throughput environment, economists suggested that please maximize throughput. So remember, throughput is a short run. Throughput is always focused on the short run. It is never focused on the long run. That is why the aim to maximize throughput will give short run benefits to the entities and not long run. These are favorite MCQ questions. Okay. Now, second, what is throughput? Throughput is simple sales price less only material cost. I mentioned it clearly, only material cost, because labor cost is not reduced here. So what does throughput says? Throughput says that I will just write it here. It assumes labor cost. It assumes labor cost to be like fixed cost and so the operating expenses, or you call it as factory cost also, includes all cost excluding material cost but including labor cost. Clear? So we are clear with this throughput. Okay, now let's move ahead. So what does throughput says to maximize the throughput return, which is sales less variable cost, so sales less material cost. Then comes the next point, ma'am. What about this bottleneck? So yes, here throughput also discusses one topic, which is bottleneck. Bottleneck means what? For example, you want to drive a car, but you don't have a license. Okay, so your license becomes a bottleneck because you know how to drive the car, but what you don't have is license. Without license, you cannot drive the car even if you know how to drive the car. Hence, this bottleneck becomes your license becomes your bottleneck. Clear? So likewise, what is a bottleneck then for a business, for an industry, for a manufacturing environment? What is a bottleneck? Bottleneck is like a constraint or like a blockage in the full capacity utilization of the business. A blockage, a bottleneck can be labor hours, can be machine hours, can be the material quantities that we have ordered, right? The material that can be processed. So all these can be bottleneck. And remember, there will always be a situation where there is at least one bottleneck always there. Always there. So let's say I have a product that passes through three machines. There is machine 1, machines 2, and machine 3. This product will go from machine 1 to 2, then it will be processed here, then it goes to machine 3, and then it finally goes to the final customer. So now understand, if my machine 2 is underutilized, even if I'm utilizing full of my machine 1, even if I'm utilizing full machine 1, then also my capacity is reduced. So I will be able to transfer 100% to machine 2, but machine 2 will not be able to transfer 100% to machine 3. And so machine 3 will not be able to transfer 100% to final customer. So here my machine 2 becomes a blockage. Let's say then what does throughput says? Throughput says, boss, don't worry, try to elevate this bottleneck. Okay, try to elevate the bottleneck. And this is what throughput says. So now here we would elevate this bottleneck. Okay, now question will always give you this situation. They will say that, why do you want to elevate this bottleneck? Let's elevate machine 1 or let's elevate machine 3. Elevate means increasing the production capacity or the overall hours or capacity of that machine. Never accept this, because even if I make it like 200%, will it matter? Because my production will be less due to machine 2. So non-bottleneck constraints, there is no use to elevate them. It will not make any difference in your overall output, in your overall returns, overall contribution, overall throughput. Your aim is always to elevate the bottleneck resource. Here the bottleneck is machine 2, so we would try to elevate it. Right? I hope I'm very clear. Once you elevate it, then your production capacity of machine 2 will increase, and then of course you will be able to transfer more to machine 3. But then will it mean that all bottlenecks are over? No. The moment you have, for example, the moment you have elevated your bottleneck machine 2, now your bottleneck will be next. Now your bottleneck will not be machine 2, but then may become machine 3, may become machine 1, or leave that, maybe something else becomes a bottleneck, maybe materials becomes a bottleneck, maybe demand becomes a bottleneck. So remember, there will always be one bottleneck that will be there. And the theory of constraints or throughput accounting, this theory of constraints simply tell you, that the focus of the organization should always be to elevate the bottlenecks. So what is the theory of constraints tell you? I will just write it here. So theory of constraints, or we call it as TOC, simply tells you always identify the bottleneck, elevate the bottleneck, and now look for the next bottleneck. So theory of constraints simply tell you that, boss, this is an ongoing process and it will always be like this. It will always be like this. There will always be some resource that will always be a bottleneck. So that cannot be avoided. So hence theory of constraints tell you this point. Right? I hope I'm very clear on it. You have any questions and queries? Feel free to ask me, guys. Okay, now let's move forward. Now we know about this now. So now elevation of bottleneck, we are very clear about it. Now when we go forward, so let's understand the three ratios that are like, you have to know them mandatorily, compulsorily, they will always be asked. So that is the ratios for calculating of TPAR, throughput accounting ratio. What are we doing here and why are we calculating it? We are calculating throughput accounting ratio because we want to see whether the return that is the entity is having per bottleneck resource and the cost that is there per bottleneck resource, whether the return is able to cover the cost or not. Because of course, the aim of the organization is to maximize the throughput. So to maximize the throughput, we need to be in a profitable position, correct? So we see whether my throughputs are sufficiently covering the cost or not, the expenses or not. For that, we do this TPAR. Now look at my screen. So now here I have return per hour. So first ratio is to calculate return per hour. Remember 2, 3 very basic points, you know, that can be skipped by you very easily. When we calculate return per hour, remember that we always calculate it in terms of per unit. You will get the throughput per unit and divide it by the bottleneck resource per unit. And when it comes to cost per hour, then we will always calculate it in totality. Which means what? You will take total cost, total operating expenses and divide it by the total bottleneck resources. Total you will always take. So ultimately you will arrive at per unit answering only, but the way to calculate is different. The moment you get your return per hour or the return per bottleneck resource that we say and cost per bottleneck resource, then the next step is to calculate the TPAR, throughput accounting ratio, which is simply return per hour or return per bottleneck resource, which is typically in hours in your questions, divided by cost per bottleneck resource. Clear? Right? Now I think with a quick small example, I can make you understand this. So I am taking a small example to make you understand TPAR. And to do more questions on throughput, please refer to my section A marathon and section B marathon, where I've taken a lot of throughput questions. Okay. And with proper understanding, we'll solve them. So let's take an example here. Let's take that there is a product A that requires 4 machine hours to process, right? And machine hours are bottleneck are scarce. So now we know that it is bottleneck. Now the next one, the total machine hours available are total machine hours available are 650 hours. Okay. Now the question also gives you that selling price per unit is 120. Material cost per unit is 35, and it also gives you other factory cost is 13,000. Okay, now we have to calculate TPAR. Okay, now let's see. So let's do the calculation, guys. All of you, can you try to solve it and give me the answer? What is your TPAR? I'm giving you 1 minute if you can solve it, otherwise I'll do it. Quickly, in 1 minute you have to solve this. Quick, quick, quick. I want your answers. Use your calculator to solve it quickly. Anybody with the answer? Anybody with the answer? Quickly, let's see who answers it first. The one who answers it first will receive claps from me. Quickly, what is the answer here? What is TPAR? 30 seconds more. Now I think I have to solve it. Is it? Okay, let's try to solve it. First, we'll have return per hour because machine hours. Okay, Anjali has given me the answer 1.06. So let's see, Anjali, do I have to clap for you or not? Yes. Very good, Anjali. Perfectly done. Absolutely correct answer. It is the correct answer. Your TPAR is 1.06. Fantastic. Very good. So let's quickly solve it. What is TPAR? TPAR is equal to return per hour divided by total cost divided by total bottleneck hours. That is here machine hours. So what is return per hour here? Return per unit is given to you 120 less 35, and this divided by 1 unit requires 4 machine hours. In total, I will divide it by total operating cost is 13,000 divided by total machining hours, which is 650. So like Anjali gave me, the answer is 1.06. Now, quickly, one small quick question that I want to ask from everyone. What does 1.06 implies? Is the entity doing good or not? What does a TPAR of more than 1 implies to you? Is the entity doing good or not? Quickly answer that in the chat box. A TPAR ratio more than 1, is it good for the entity or does it show that the expenses are more? Quick, quick. Absolutely, it is showing that the entity is doing good. And why it is doing good? Because more than one TPAR shows that the returns are covering your expenses. So always remember, yes, Anjali, very good. Always remember that a TPR of more than one is what we look for. Now, next, uh, the aim of the business is to maximize throughput. So how do we maximize throughput? For maximizing the throughput, we need to have the ranking done, right? Just like we do a ranking for contributions. So what you will do is step one, you will calculate throughput per unit. Step number two, calculate throughput per bottleneck resource. Step number three, rank the product. The product with the highest throughput, the product with the highest throughput will be given rank 1, and then the next one, and then the next one. So optimum production plan, when the question asks you, is the plan where you are maximizing your throughput. And how would you maximize it? By maximizing the production for the product with the highest rank, because the product with the highest rank means highest throughput, and highest throughput means maximum earnings for the entity. So remember that optimum production plan is the one in which maximizing of throughput is there to cover the operating cost. Hence the product with more throughput, that is rank 1, will be manufactured to the maximum demand, then rank 2, and then rank 3. Done. That is completely everything about your throughput at one place. Okay, any questions and queries that you have in throughput, please tell me quickly. Any questions anybody has in throughput? Okay, let's move on to the next one. Clear? Okay, next topic that I'm taking is environmental accounting and sustainability. Okay, what is environmental accounting? And this is one of the topics that students normally leave in the exam, I've seen, because they consider it to be very easy and they think that it is going to be less tested in the exam. But let me tell you guys, it is a frequently testing topic in the exam. It is frequently tested. Okay, so now please look at my screen, and very important is to understand first this terminology, sustainability. Okay, sustainability means what? Sustainability simply means we should go hand in hand with the environment. What does it mean? It simply says use the resources in the most efficient manner so that there is no compromise with the needs of future generation, while meeting the needs of present generation. Okay, it simply means that there has to be no compromise anywhere. Anywhere there has to be completely no compromise. And sustainability does not only means environment, it simply says that your environment, society, and your governance, everything should go hand in hand. So the businesses should not only look for maximizing the profits, but they should also look for serving the environment, serving the society, making more employment opportunities, poverty eradications, working for the society. So, and ensuring that environment is also supported. So by doing a lot of CSR activities that do that, governance is there to ensure that there are transparent policies, gender equality, for example, is there. And the overall profit maximization is not the only aim. That simply says that the businesses have to look beyond it. Done, clear, good. Now, like what can be done for the environment? For the environment, we can do like CSR activities, I told you. For the country, the aim is to taking the steps, increasing the exports, for example, so that the economy as a whole grows. For the government, what can the businesses be doing for the government? Now for the government, it can be done, that is, like creating more employment opportunities. What can be done for the staff? Gender equality. These are sometimes asked in the MCQs, which of these are sustainability goals? So there you'll have to select that. For public, what can be done in general to ensure that the goods are, sold in the most transparent manner, and they are basically, quality is not compromised. Right? Creating more employment opportunities, eradicating poverty, all of this will also come here. Now let's go forward and let's just see the next point. Now this is very, 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 I mean, a lot of varies I can add here, because environmental accounting, guys, it is one of the most frequently tested topic in the exam. One of the most frequently, and students generally falter here. Generally they falter because they are not aware of what is the prevention cost and what are the different type of costs. So let's have the complete clarity of it. Now, number one, the environmental accounting, the two economists, they gave their views on the type of environmental cost. One is Henson and Mendoza, which is a very frequently tested topic in the exam. So as per Henson and Mendoza, the following are the type of environmental cost. Number one, prevention cost. Number two, detection cost. Number three, internal failure cost. And number four, external failure cost. Okay, now, what are prevention costs? Understand it. Prevention cost. Prevention means what? Don't we say prevention is better than cure? So the cost that is incurred even before you are doing any kind of environmental activities, like even before you start doing production which may release the pollution in the air, you are taking steps to ensure that step is itself prevented. So what would you do? What would you do here? So for example, having the clear-cut organization policies on the environmental assumptions and following the rules and regulations, installing such equipments whereby we may not have only pollutions in place, like PUC that I install at home, the pollution control equipment. So why do I install it? So that I don't have even any kind of pollutions in my place. Okay, so that's a prevention cost that I'm incurring, having a clear-cut environmental policies. So the staff who is working will not do anything which is against the environment. Done. Now the next is detection cost. What is a detection cost? Right. Now when I say detection cost, now detection means what? Now you want to frequently check whether the pollution levels are crossed or not. So you're trying to detect what has happened. So here, for example, we will have a system to check carbon emissions from the factory. Like we have the systems installed that will check what are the emissions that are taking place. Right now, we are not looking into, oh, my environment has got degraded. No, we are just looking into the case wherein I am trying to find out whether emissions are taking place, at what levels are taking place, and what. Third is, now your environment effect is taking place, because now let's say there is a lot of wastage that has come out of your production process. So now you need to recycle that scrap. Okay, now so that is your internal failure cost, wherein the failure has not yet been released into the environment. Pollution has not yet gone outside your factory, but it is taking place. Emission levels are going high. So internal failure cost, like I told you, is like in recycling of scrap, because there is a lot of scrap that is produced as a result of the production process. So we need to recycle the scrap. And when you do recycling, that's simply your internal failure cost. Clear? Right? It means the environmental damage is done, but is still contained in the factory itself and not released to the environment. Simple. Last is the external failure cost. Now your pollution, your everything has been released into the environment. So now, for example, you're paying fees and penalties for the emissions that have gone beyond the limit. Okay, the pollution has gone into the environment, the river water has got degraded. Now you're taking steps to clean the river water. So what is this? External failure cost. Because the emissions went into the environment, you need to clean up that. Cleanup cost that we have is again an external failure cost. Clear? So I hope now in the exam, identification of cost is not a trouble. Now next categorization of the environmental cost is given by US Environment Protection Agency. Okay, US Environment Protection Agency. And as per this agency, the environmental costs are, again, here also we have four types, but they're different. First is the preventive cost, that is just like the prevention cost only. similar. Second is a potentially hidden cost. Third is image and relationship cost. And fourth is a contingent cost. Prevention cost is just like what we've studied for the prevention cost on the same lines only. So prevention cost is basically like the cost of disposal of waste, the cost of energy plant facilities, electricity. So all those costs that we are incurring, basically, okay, all those costs that we are incurring uh, to ensure that the pollution, the all these damages are not done to the environment. So like we have the cost of disposing of the waste, we have the cost of using electricity, so that we are using less of the coal and all, right? So cost of electricity, cost of power, cost of measuring the pollution control equipment, right? And cost of running, actually it's not measuring, cost of running the pollution control equipment. So now these are generally those costs which are usually identified in advance by the company and are treated as voluntary. So I'll just make the definition clear. These costs are usually identified in advance, okay, and accounted for. And they're already accounted for in the books of accounts by the company, generally by way of under the traditional costing system. Traditional accounting system. Okay, so they are accounted for under the traditional accounting system. They are the normal cost, like the electricity cost, power cost, like I gave you here, the energy plant cost, the the cost of this pollution control equipment. So these are clear costs which are identified very clearly in your accounts. These are the prevention cost. So this is a tip for you for in the exams. The cost which is very clearly identified is your prevention cost. So identify like that also in the exam. Second is a potentially hidden cost. So it is the cost which is generally hidden in that overhead cost that you write, which is not specifically accounted for in the accounts. For example, water scarcity cost. Okay, like for example, pollution related cost, water scarcity cost. You don't find these costs in your overheads, right? But it is a part of your overhead cost. So you need to show them separately now. So these costs are a part of other costs incurred like overhead, like monitoring cost, administration cost, for example. Okay, and so they are generally not very clearly identified, not very clearly shown separately, and they are just shown as a cost which is as a part of the other cost. So they are not clearly shown as separate cost. Clear? Done. Let's go to the next one. Image and relationship costs are like the image building cost. For example, the entity does the CSR activities. Why? So that the image building is done. So it is an image building cost. The environmental reporting that they do, like sustainability reports that an entity prepares, is to build up a clean image so that the public becomes more interested in that company's product and they build a public trust. So they focus to build image of the entity on an economical, environmental friendly one, so that the public trust is won and public shows interest in that entity. Next is contingent cost. These costs are like the cleanup cost, the penalties that are not going to incur right now, but will be incurred in the future. But we account for those costs as well, and that is why we call them as contingent cost. So as per the US Environmental Protection Agency, these are the four costs. In total, we have understood the 8 type of environmental cost. Guys, any questions and queries you have, you can freely put up in the chat box and I will take them. Okay? Now, let's go to the next point. So that's all for environmental cost, nothing else. Just make sure that you handle the sustainability and environments in this way. Yeah, there is just one more point that I would like to cover here, which is relating to the flows, because that is also very frequently tested topic in the exam. So just give me 1 minute, I'll open my book, and from the book we will understand about the environment. I'll just discuss the waste flows. Yeah, this is very important. So please look at my screen, and this is your input output flow analysis. When input output flow analysis simply says that there is input which is entering the system, then there's processing, and then there is output. When we have output, we have a scrap also which is there, we have a residual waste also there, and we have the final output also which is there. So this step encourages the organization to recognize what are the potential environment related costs due to the waste that has taken place, due to the inefficiencies which have taken place. Done. So yes, it can lead to an external failure cost as well. Right? I hope I'm very clear. Okay, one more point that I would like to explain here is the flow cost accounting. Flow cost accounting is a very popular topic for you in the exam. For flow cost accounting simply says that the materials in the organization will do movement through these three main types. Number one is you will have material flows that flows throughout the organization. Next is the system and delivery flows. System and delivery flows System and delivery flows simply tell you the processing stage. So you have the input stage, which is the material flow. You have the processing stage, which is the system flow. And then you have the output phase, which is your disposal flow. How your material waste is going to be disposed of. So you input material, you do processing, you have output, and finally you have disposals of the material of the wastage. So this is what we know as the flow cost accounting in environmental accounting. Very, very popular topic in the exam. Students mix it up with input output analysis. It's the same. Yes, I understand. Just the terminologies are different. Make sure that you have hold of these terminologies. Okay. Anyone having queries, put up in the chat box. Now, let's go to the next one. So, from your day one topics, we have completed two topics so far. We have completed throughput accounting and environmental accounting. Okay, now let's discuss more. So now I'm starting with CVP analysis. I think one of the most tested topic, and that topic that students always come up and tell me, ma'am, I don't know, but CVP is a bit difficult for me at some areas. So let me make it very, very comfortable for you by discussing the main pointers here. Okay, let's make it very comfortable. I think in a quick way, I can take just quickly one question also in environmental costing, although I've taken more lot of questions of section A and B already in the marathon. But let's just have one quick question so that we have complete understanding of it. So this is the book that I provide to my students in the class, and the same book I'm using right now to make you do some questions. Okay, let's quickly have one question, and all of you, those who are listening to me, who are watching this class, everybody, I want this answer from your end. Only one cost. Which of the following will represent an environmental cost that arises due to a failure to prevent wait. Okay, we will do this question. It's a very good question. Let's do this. Okay, look at my screen and quickly. You have to classify the following cost in the environmental cost categories. Okay, that is prevention, detection, internal failure, and external failure. Let's quickly do this question. So everybody who is with me in the class right now, please try to solve this and give me the answer. Number one, a company grows various type of tea leaves. This is the question, and blends them together. The tea leaves are handpicked, and because using machines caused excessive damages and waste, after harvesting the leaves are dried and processed, and the waste is recycled. The company regularly tested tea for contamination in line with the food safety regulations. Recently, one tea plantation was found to have high levels of soil contamination due to new pesticide. Classify the following costs. So quickly guys, I want answers. Number one, what is the cost that is incurred to clean contaminated soil? We will term it as internal failure, external failure, prevention or detection. To clean the contaminated soil. Prevention, detection, internal failure, external failure. Quickly put up in the chat box. Prevention. Okay. So I have received the answer as prevention. No, my friend. Just see, the soil got contaminated. Soil is our environment. That means your environment got affected. So it is my external failure cost. Your soil has got contaminated. You have damaged the environment. So now you are incurring cost to clean that environment damage. What is this? External failure cost. Clear, Anjali? Make sure that you understand this now. Right? Okay, let's do the next one. That's okay. Do errors so that you will learn from them and improve in the exam. Next one. Staff cost for handpicking the tea leaves. Okay, now the cost is incurred to hand pick the tea leaves so that the tea leaves don't get damaged. Now what is this cost? Tell me quickly. Hand picking the tea leaves. What is the perspective of management? To prevent the cost, the damage, to detect the damage, to do internal failure, or to have the external failure? Which is this cost? Put it in the chat box quickly, everybody. Okay, let's try this. So it is a prevention cost. Why? Because the entity is on a safeguarding side. It is hand picking the leaves, not using the machines. Otherwise, the leaves could get damaged. So right now, it's step one only. We are being precautionary. So this is a prevention cost. Third one, cost incurred in recycling waste. Recycling. This is easy question. Tell me quickly. When we recycle the waste, what kind of cost is it? Internal failure, external failure, or it is prevention or detection? Recycling. Quickly put it in the chat box. Very good, very good. Yes, it is internal failure cost. Very good, Anjali. The last one, cost incurred for testing T. Testing means what? You want to detect, right? You want to check the levels. So it is a detection cost. Done, clear. I hope now the concept of these costs are very, very clear to you. Okay, let's go to the next one. So now I'm starting with CVP analysis. Now, what is CVP analysis? Typically, just understand it's a cost volume profit analysis, and the focus here is to focus on break even point. Okay, so here we are covering break even point. Simple, we are covering break even point. Now, what is break even point? Break even point is the point at which there is no profit, no loss. Okay, no profit, no loss is the situation. So simply we can say that at this point, your contribution, so we can say that at break even point, the contribution is equal to fixed cost. Because there is no profit, no loss, so no difference is there. The contribution is equal to your fixed cost. Okay? Very good. Now, what is CVP analysis? So what are we going to study here? We will be studying two typical scenarios where there is a single product and a multi-product environment. When it comes to single product, if you have to calculate your break-even point, you would always do two calculations: break-even point in units and break-even point in revenue. Okay, break-even point in units formula is very simple. It is the point at which your contribution is equal to your fixed cost. So this is typically the point where your fixed cost upon contribution is there. So we will do fixed cost in total divided by contribution per unit. So here I will just elaborate it. I will get fixed cost in total and we divide it by contribution per unit. Okay, contribution per unit, we will divide it. Done, you will get your break-even point in units. Now let's go further. If I have to calculate break-even point in revenue, simply take units and multiply it with selling price per unit. Done. Or alternatively, you can also calculate break-even point in revenue by using a formula, which is total fixed cost by CS ratio. So this we can say that it is equal to fixed cost in total divided by CS ratio. Clear? If you want to calculate the break-even point in units from the CF break-even point in revenue, simply divide break-even point in revenue by selling price per unit and you will get break-even point in units. Okay, so that can also be done. Clear? Now what is CS ratio? Contribution per unit divided by selling price per unit. Clear? Absolutely. For a single product, life is very simple. Sometimes the question may say that there is a target profit to be achieved. So then in that case, in case of target profit, your break-even point will be, let's say I want to take break-even point in units, then your break-even point will be fixed cost plus target profit. And this divided by contribution per unit. Okay, so this is the formula then you will use for target profits. I hope I'm very clear on it. Okay, let's go to the next one. So the next one is a situation where you have a multi-product environment. Multi-product means an entity makes product A, product B, product C are the products that the entity is making. They are in different mixes like 20%, 30%, 50%. They are making in this mix. So now the question is, how would you calculate break-even point in this case? See, whenever you have multiple products, you will use weighted average. So whether it is contribution per unit, you will divide total fixed cost by weighted average contribution per unit. When it is revenue, directly you are calculating with CS ratio, you will calculate weighted average CS ratio. Weights means what? You multiply quantities with it or you multiply the ratio percentage. So okay, now, so please just look here. In order to calculate the multi-product break-even point, I have simplified it by telling you about the two methods that you can use to calculate the multi-product break-even point. Okay, I have drafted these two methods, kept as a summary here so that you will never forget in the exam. Now please look here. What is the first method? The first method is step 1. Step 1 is calculate the weighted average CS ratio or calculate the weighted average CS ratio. Ma'am, how do we calculate weighted average CS ratio? Let's do the calculation here. So I will just write here weighted average CS ratio will be equal to total contribution of all the products divided by total revenue of all products. Okay, so total contribution of all products and total revenue of all products, we will be taking it to use the weighted average CS ratio. Now, the next step here would be, then you will calculate break-even point in revenue. How would you do it? Fixed cost by weighted average CS ratio. Easy, calculated. Now, you will allocate this break-even point to the different products, because you have got the break-even point in revenue for the entire entity as a whole. Now I want break-even point in revenue for individual products. So how would you do the allocation for the individual products, guys? You will do the allocations by allocating this break-even point in revenue in the sales mix. The sales mix which is given to you, in that ratio you will be allocating your break-even point in revenue. So quickly, or we call it as weighted average selling price. What is weighted average selling price? Including the weights, multiplying the quantities of the mix and get the selling price for each of the three products. So not just the selling price per unit multiplied by the number of units. So you will get the total selling price for each of the three products. In that ratio, you will allocate the weighted average, you will allocate the break-even point in revenue. Done. So now you've allocated break-even point in revenue to the three products. Now divide this by the individual selling price of the three products and get break-even point in units. So easy, very easy this is. Please use this approach only. Okay, please use this approach only, and I'm sure your all workings would be very, very comfortable and very, very easy. Just 1 minute. Okay, now let's go further. So now I'll just revise what we have done for the first method. The first method, to understand the break-even point and revenue in case of weighted averages, calculate the weighted average CS ratio like I told you. Second step is, now you calculate the break-even point in revenue for the entity as a whole and allocate it to the different products in the ratio of their weighted average selling price. Get the total selling price of each of the product. In that ratio you allocate it. When you got individual break-even revenues for each of the products, step 3, divide this by the selling price per unit for the product, each of the three products, and you get break-even point in units for each of the three. Simple 3-step process. Another method, if you're not comfortable with this method, let's take the next method. What is the next method? The next method is, ma'am, number 1, step 1, calculate the contribution per unit for the different products and only calculate weighted average contribution. Okay, so you will just calculate weighted average contribution and not weighted average CS ratio. You just calculate weighted average contribution per unit for the different products. We can do that. Weighted average contribution is easy. And how would you do it? Multiply it with the mixes and you will get your weighted average contribution per unit of all the three products. Once you know your weighted average contribution per unit, you can calculate your break-even point in units. Easy. Step 2. Third step is, now you've got the break-even point in units, allocate it to the different products in the ratio of their mix or in the ratio of their weights that we have calculated. So now you can allocate the units to both or more of the products, whatever it is. Generally you have 2 product questions. 3 products also you allocate it to the products. Now you've got individual units for each of the product, multiply with their selling price and you get your answer. Okay, so there are 2 steps, 2 ways of doing it. One from the CS ratio approach, another from the contribution approach. But both ways you have to use weighted average only. Multiply the quantities or the percentage which is given to you in the question. Done, done, done. Clear, absolutely. Okay, yeah. Now let's take the next one. Any questions, guys? Feel free to ask me in the chat box. Okay, let's go to the next one. Now the next one is very important area of your syllabus here in the CVP analysis, which is the creation and interpretation. See, creation is not there in your syllabus, but what is there is interpretation. Interpretation is very, very important. For the PV charts, see, a lot of charts are going to be given to you in the exam which you have to interpret. That is not difficult, but what is difficult is interpretation of the PV chart. So remember that point number 1, whenever the PV charts are drawn and that you are interpreting in the exam, the graphs, 2 pointers you just have to keep in mind, and that's all. Your PV charts will be like this solved. Okay, so now continuing with the same level of understanding and energy, guys. The PV chart which is drawn for multi-products is in accordance with the product with maximum contribution to be made first will touch x-axis at early break-even point. That simply means That simply means that when you're creating the PV chart, you will do it always in accordance with the CS ratio. Okay, so we single PV chart you create with the contributions, right? So single PV chart is, this is your PV chart. Okay, when you're just making for a single product, this is your fixed cost, let's say it's here, that will be incurred, and this is a loss, and this is your profit. Here technically you have profit, here you can have units or revenue, whatever the question gives you. Okay, the point at which it touches the x-axis is your break-even point or revenue as per the question. This is your profit angles. So this is how we make the single product PV line. In case of a multi-product PV line, again contribution is the base, but then we use CS ratio. So you prepare the CS ratio for each of the products, and the product with the highest CS ratio will be plotted first, then the second, then the third. So we always create multi-product PV charts by ranking the products as per CS ratio, and as per the ranks, the rank 1 will touch the x-axis first, and then it will touch the rank 1 will touch the y-axis first, then rank 2 and rank 3. The point at which it cuts the x-axis is the break-even point in dollars or units, as the question may give you the scenario. Okay, I will just quickly take you to the book and just make you understand one pointer for the CVP analysis. So be there on my screen, please. Just look at this chart. This is very important that I just want to explain. Okay, this is very important. Please look at the screen. Number one, the most profitable, that is the product with the highest CS ratio, will be plotted first. So this line that we plot is as per the CS ratio rankings. When you join this point and this point, it simply shows your budgeted sales in the constant sales mix. Okay, so when you join this point and this point, it simply shows your budgeted sales in the constant sales mix. Frequently tested topic in the exam, and MCQs trouble you. So that is why I'm explaining you this point here. So let's see here, I have revenue. So which is the break-even point? This or this? This is always your break-even point. This is your budgeted revenue point. So this is your budgeted revenue and this is your break-even point, and in between you will have margin of safety. Clear? Okay. Yeah, margin of safety also I have to explain you. Right. So I will just discuss the margin of safety also. So let's understand margin of safety here. Now what is margin of safety? That also question asks you to calculate. Margin of safety is nothing. If you have to calculate it in units, then it is simply, or it is in dollars, let's say. Generally it is calculated in dollars. Okay, then it is simply the difference between your budgeted revenue less break-even revenue. Okay, when you're calculating it in terms of percentage, then you will calculate budgeted revenue less break-even revenue divided by budgeted revenue and multiplying it with 100. So these two are generally the frequently tested points for margin of safety. Done. So we have completed here 3 chapters: throughput, CVP, environmental and sustainability. The 3 topics that we have to cover, we have covered 3 topics so far of all the topics. Now let's go to the next one. So I will take up now So now I'm taking up target costing and life cycle costing. So target costing and life cycle costing is the next topic that we are taking up. Guys, any questions and queries that you may have, please put up in the chat box. Okay, so before I resume with this topic, let's just have a quick 5 minutes break, only 5 minutes, and don't go anywhere. After this, we will do target costing, life cycle costing, and we will do relevant costing, limiting factor constraints, and we will do pricing so far. Okay, so let's just have a quick 5 minutes break so that you also refresh yourself, and then we'll start with this. So don't go anywhere, stay tuned. In 5 minutes, we will resume again. Yes, so how's the energy level, guys? Tell me quickly. All those who are here, energy levels are super high, all ready to go further into this syllabus. Please tell me quickly. Okay, let's proceed further. So now let's go ahead and discuss the remaining pointers. Now we are doing this chapter which is target costing and life cycle costing. So first I'm taking life cycle costing eyes on my screen quickly. Life cycle costing typically revolves around only identifying the stages in which a product is there in a life cycle. Life cycle costing simply says add up all the cost for the product right after it is born until the product dies, that is phases out of the market. So right when the product is entering into the research design phase, we take up the cost, we add up all the cost that is incurred during the entire lifetime of the product till the product is phased out of the market and the product is now no longer there in the market. So we take all the cost right from start till the end. And this is what your life cycle costing is all about. Simple. This is your life cycle costing all about. Okay. Now let's just understand the recap again. Number one. So what are the stages in the life cycle costing? Stage one. That is you will start after, not actually we say after, but the life cycle cost starts during research and design phase. Okay, your life cycle cost will start during the research and design phase, and you will take all the development related activities here, like the product development activities, be it the development of a prototype, designing of the product, planning of the product, development of the product. All these activities will be covered here when it comes to life cycle costing. And very important pointer, the major cost of the entire product's life cycle is incurred in this phase, the major cost of a product's life cycle. Then the third phase is, this is into practically this becomes a first stage combined. This is the second phase when the product is introduced to the market. So of course when a product gets introduced, you have a lot of marketing expense, advertisement expenses, salary expenses being incurred, and also you invest heavily into non-current asset, right? So a lot of fixed cost gets incurred in this phase because right now you have introduced product to the market, so a lot of early costs are incurred. When it goes into the third phase, then your product is growing, it is into the growth phase, your product is growing, so you have a lot of variable cost being incurred because as your product gets more sold, more variable cost is incurred here, fixed cost has become stagnant, so you have more variable cost that gets incurred here. This is actually the fourth stage, phasing out. This is third and fourth combined here. And this is the fifth phase. Okay, so third phase is when your product is growing. So remember that in your growth phase, which is your stage fourth, say third, in your growth phase, you'll have mainly variable cost incurred. Very important, mainly variable cost will be incurred. Likewise, when you go to a maturity phase, now your sales have become stagnant. So this is the point where you have maximization of your revenue also that takes place. Maximum revenue is here because your sales have become constant and they have become stagnant. You have reached the highest point of your selling. Every company wants to maximize this growth phase or the maturity phase because this is the profitable phase for them, correct? So they want to maximize it. So fourth phase is the maturity phase. Maturity phase is your sales are at the highest point, because now you're at the highest point over here, and after that they'll be declining, that will take place. So here also majorly your major variable costs are incurred a lot. And here, though in the fourth phase your variable cost will reduce a bit because you have less of the selling now, because you have reached the peak point now. Now no more growth is there. And fifth phase is the final phase where the product phase out of the market. So your fixed cost will be incurred here again, because you will have the cost to decommission the product or dispose of the product. So here you will have again more of fixed cost and less of variable cost. Why less of variable cost? Because the product demand is less. Since the product demand is less, your product is going to be costing you. So you are making less of that product. Making less of the product means less of variable cost. Done. That's entirely your life cycle cost. So all costs from the development phase and the phase out phase are to be included when we calculate life cycle cost. So you calculate total life cycle cost and then divide it by the total number of units that are expected to be produced and sold throughout the life cycle to get the life cycle cost per unit. Your question will ask you this. So life cycle cost per unit is total cost, incurred in the product life cycle divided by the total number of units produced and sold in the life cycle. Done and clear? Yes? Everybody? Great. Let's proceed further. I'll just show you the life cycle chart again so that we are absolutely clear with this and there is no confusions here. I hope my screen is visible and you can see it clearly. This is your development phase where the product has not yet been introduced into the market, so you don't have any sales. Then your product gets introduced, your sales go up, profits go up, and cash flows also go up. Then you have the growth phase, then you have maturity phase. You can see the highest point of sales is in maturity phase. But it is not necessary that highest sales will give you highest profit. For that, you have to do MR is equal to MC. That equation will give you maximum profits. And then the product goes into the decline phase. Clear? Just one point I would like to tell you here, the table, when the product is in the development and the research phase, then typically you don't have any major cost except for the research and development. So here a fixed cost is high. When you are introduction phase, again fixed cost is high. Growth phase, variable cost goes up. Maturity phase, typically we have more of variable cost also. I mean, fixed cost is stagnant now. Decline phase, you have variable cost and fixed cost also that gets incurred here. Done? Clear? Okay, let's go to the next point. So now we am taking up target costing. What is target costing, guys? Target costing is simply the aim of the business is to maximize the profits, right? In order to maximize the profits, when I know my market is competitive and I've got the target selling price, now you have got the target selling price. From there, you reduce your target margins, because every entity will survive only when they're able to achieve these margin percentages. So from that target selling price, please reduce the margins and you will get your target cost. Okay, so we go reverse. You will get your target cost. Now the aim of the business is to find out the actual cost, compare it with the target cost and try to reduce this cost gap. Because if we don't reduce this cost gap, then the pressure will be on profits. And if profits get shrinked, then the business survival becomes a challenge. Clear? Now what are the ways by which we can reduce this cost gap? Number one, by adopting value analysis. As per value analysis, the concept says that look, there are four values that an organization will have. The values are number one, use value, exchange value, cost value, and esteem value. Let's go quickly for each of these. Use value means what? What is the use that you're deriving from that? So let's say when I'm using my laptop, my use value is that it is helping me in aiding to provide the classes. So this is the use value. So even if it may not be too much useful for me to other ways, but for my classes it is very helpful. So for me, then the use value is utmost priority here. Okay, and I would look for a product that maximizes the use value for me. Clear? It is simply the product's ability to perform its functions as desired. Exchange values, when I want to, let's say, sell off my laptop right now, what is the value that it will fetch? So it's market's worth. This is a secondary point for me, because when I'm looking for maximization, I would like to maximize the use value rather than maximizing the exchange value. Next is cost value. Cost value is what is the cost of making the product. So obviously the aim of the entity should be to minimize the cost, correct? Esteem value is the prestige that you attach to that product. Whatever is the cost, whatever is the revenue, it really would not matter. What matters is what is the value that you attach to this product. Just 1 minute. Just tell me, I hope my screen is absolutely clear. It just got shifted a bit. Okay. Anyways, if it is not clear, do let me know in the chat box. Okay, guys. So now we know the four analysis. The aim of the business should be to maximize the use value and the esteem value. Remember it. Esteem value is we add that value to the appeal of the product for the customer. So for me, for example, Apple iPhone gives me prestige value. So even if its value is high, but I want to make sure that the best quality is served with that value because it carries my esteem. So that is what esteem value is. The maximization of esteem and the use value is the main purpose of a business. Done? Clear? Now the next step is value engineering. Value engineering simply means that was the major cost of a product life cycle is incurred in the design phase, planning phase, development phase. So whatever changes you want, please make it in that phase. Let's say I want to use a lower grade of lower quality, not lower quality, I want to use a substitute of a raw material which is almost of the same quality but lower cost. It will help me to reduce the cost, but when will I be able to achieve it? I will be able to achieve it in the design and planning phase, correct? Where I will change the raw material. So when you make these changes, so this is known as value engineering. Okay, value engineering simply means making changes to the product to bring down the total product cost without compromising on the quality, and it takes place in the planning and design phase. Why? Because this is the phase where the major expenses are incurred. Okay, so the aim of the business is to remove the unnecessary parts or the measures or unnecessary cost. And therefore we do it in the planning and the design phase only. I hope that my entire class is absolutely crystal clear with this. If you have any questions, any queries, guys, feel free to put it in the chat box. Great. Okay, now let's go to the next one. The next topic I'm taking up is, so let's just quickly have a look at the list that we were preparing. So in that list, we have covered throughput, environmental and sustainability, target and life cycle costing. We have done CVP also. That was not listed down here. So I will write here CVP. That also we have done. Okay, and now I am focusing on relevant costing. So let's do relevant costing and limiting factor analysis first. Okay, let's do limiting factor first. So let's do this topic. Till this point, any questions and queries, put up in the chat box. And I hope that the revision session is going fine and you're having complete hold of the topics. You can share your feedbacks in the chat box so that it gives me an insight about that whether this session is really helping you all or not. Okay. So let's start with limiting factor analysis. Okay, let's start here. Now, limiting factor analysis discusses about the constraints. So remember throughput where we discussed about the bottleneck. Limiting factor analysis will talk about constraints. It simply says that every business is not necessary to have only one factor that stops its maximum production capacity meeting the maximum sales demand. It can have the multiple constraints also. So limiting factor says that not just one factor is necessary to be there, rather we'll have multiple factors, and limiting factor focuses on contribution. So here the focus is to maximize the contribution. Okay, we will be doing maximization of contribution. So here what you will do exactly just like we used to do with throughput, calculate the contribution per unit, rank the products, and calculate the contribution per limiting resource if there's only one factor, or if there is only one constraint. If there is only one constraint, which can be the sales demand, which can be the the assembly hours, the production hours, maybe the inspection hours, it can be anything. So here we just don't work on one bottleneck. We see there can be multiple constraints also. So now constraints can be like I've given here. Constraints can be labor hours, depreciation time. No, it is not. Yeah, department time. Sorry, it can be department time. Department time can be like we can have a constraint in the form of assembly department limiting factor, like limiting time is there for assembly department. We have a limiting factor for the scheduling department, like this. So department's time can be a constraint, market demand can be a constraint, and material availability can also be a constraint. So you will have so you will have, why are these constraints? Because they are limiting or delaying, or they are a blockage in the production and selling capacity of the organization, just like bottlenecks. Now, what are the constraints that we are going to study in this chapter? We will be studying situations where there are single constraints and multiple constraints. When there is a single constraint, the aim of the business is to maximize the contribution. Okay, when there are multiple constraints, then we have two constraints environment, but again here also we will make an aim to maximize contribution only. We will maximize contribution only. Okay, now here I've just given you a quick example for a production plan. So here let's say my labor hours are a constraint. I will be taking contribution per labor hour, based on which we'll do the ranking. Let's say my product A is rank 1, product C is rank 2, and product B is rank 3. So according to which, I think I can take up the question here. Yeah, so okay, let's just understand it by way of an example only. So right here we have three products, and we need to know which products will be made so that we can maximize the contribution for the organization as a whole. So in order to maximize the contribution, we will calculate contribution per labor hour. Why? Because labor hour is the scarce resource here in the example that I've assumed, based on which we have done the ranking, and on the basis of rank, product A is to be maximum product produced in full, then product C, and then product B. So according to which we are making the productions, and we multiply it with contribution per unit and get the total contribution. So this is the total contribution that you achieve, is the maximum contribution that a business can achieve with the constraint. Okay, we will look at one question also. Although I've taken multiple questions in my section A and B marathon. So again, I'm repeating, if you have not gone through the same, please go through the same. Immediate priority. Now here, so I've given you the steps. What steps would you follow when there's a limiting factor analysis? So when we have a limiting factor analysis, the steps that we need to be following here are: number one, find the contribution per unit for the product. Okay, find the scarce resource per unit of each product. What is the scarce resource, or we call it as constraint? Constraint per unit for each product. Then calculate the contribution per constraint per constraint. For example, labor hours. So then you will calculate the contribution per labor hour required. Okay, and accordingly you will rank the product in descending order. Descending order of contribution per hour. First rank will be given to the highest contribution per scarce resource hour. And then optimum production plan will be to produce the products according to the ranking till the constraint is fully utilized. So we will first make the product that gives us the maximum contribution, then the next product ranking, then the next product ranking. Done. Just like throughput ranking we'll do it here. Okay, just that in place of throughput we have contribution. That's the only difference. Now the problem comes in when there are multiple products. In multiple products, I cannot have this approach. Why? Because the problem comes in when there are multiple constraints. There can be 2 constraints, 3 constraints, 4 constraints, there can be many constraints. So then doing the ranking becomes a challenge. In your exam, you will have only 2 product environment. Okay, remember it. In your exam, you will always have 2 product environment and not more than this. But you can have multiple constraints, like you can have an assembly time constraint, production time constraint, labor hours constraint, demand constraint. You can have multiple constraints, but products will only be 2. Okay, now if there are 2 products and there are multiple constraints, then we need to follow the linear programming approach. Linear programming approach is solving the equation simultaneously to get the optimum solution. So what are the steps that we follow here? The steps that we follow here is, I will quickly discuss one example also after this so that we are absolutely and thoroughly clear on it. Okay. Now the steps that we follow is number 1, formulate the objective function. Objective function means simply you are formulating the contribution equation. And what is the contribution equation? Maximizing. So here we will take, let's say C1 is the contribution for product A and C2 is the contribution for product B, and you will always have a 2 product environment only, not more than 2. Clear? So now the aim of the business is to maximize the contribution. So my equation will be, let's say Z is the objective function which says maximum contribution. So we will have the optimum production plan to know how much of product A should be made and how much of product B should be made. Accordingly, I will multiply contribution 1 with product A and contribution 2 with product B. Clear? Okay. Second step is, guys, find out the variables. The variables are like X are taken for the units of product A, and actually it is not a second step, it is a part of the first step only. And Y is the variable for product B. Always you will have these 2 variables only. Third step is to construct the constraint equation. How would you construct the constraint equation? So for that, based on the availability of the limiting factors, that can be machine hours, labor hours, raw material, whatever it is, you will have to formulate a less than equal to equation. Because it's a constraint, you have to use maximum up to that amount only. You cannot go beyond it. So we will always try to use the resources till that limit only or less than this, which means we will always have a less than equal to constraint. So here you will have, for example, the number of hours of A multiplied with X plus number of hours that are required to make 1 unit of Y multiplied with Y is less than equal to the available resource. Like this, you will create the constraints. Then with this, you will also create your XYZ non-zero equation, mandatory when you're doing a section C question, mandatory. You got the third step. Fourth step is to calculate the feasible region. I will show you in the graph. Based on the feasible region and with the help of ISO contribution line approach, we will determine which is the most optimum combination and which is the point at which I will have the most optimum production plan. So at that point, then I will solve the 2 equations parallelly, simultaneously, which is the 2 equations which are at the intersection of that point. We will solve them, and when we solve them simultaneously, we will get the value of product A and B, what is the total number of quantity over there, and accordingly then we can calculate the contribution per unit is given to you in the question, multiply it and get the maximum contribution. Okay, these are the steps that we follow in limiting factor analysis. Now, I would just show you a graph to make you understand all these steps again quickly. So be with me, I'll open the book and I'll show you over there. Okay, can you see the graph, guys? Just see the graph. So here we have framed a less than equal to equation. I'll just show you here. Okay, so look here, how do we do the solving? I'm just showing you one example so that we're absolutely clear with this. So this is the question that we have. Okay, and I'm taking this question to solve. So I'm taking question number 8. Look at my screen and let's just solve it quickly. I have solution with me that I've solved. Okay, and we will just discuss it with this equation so that we are clear with the different constant solving, feasible region, determination of the optimum solution, binding, non-binding constraints, all that. Okay. Now, a manufacturing company produces two items, cabinets and chests. Both items they require time in two departments, carpentry and polishing. The processing times per unit are given to you. Cabinet is 3 hours, chest is 4 hours, polishing is 2 hours, and chest is 6 hours. And this is all hours required for making one unit. The company has 4,800 hours of carpenting time. That means it is a limiting factor, it is a constraint because it is limited. And polishing time is also limited, only available till 5,000 hours. Additionally, the production of cabinet is also capped at 1,200 units per year. So the demand for cabinet is also restricted to 1,200 units only for a year. But chests have no maximum limit. So the chests have no maximum limit which is given to you here. Chests have no maximum limit. Okay. Now, each cabinet earns a contribution of 100 and each chest earns a contribution of 150. So what are the variables here, guys? The variables here are X and Y, and X is chest, cabinet. Let's say X is cabinet, the number of units of cabinet, and Y is the number of units of chest. So we have drawn down the variable equation, the variables. Second is draw down the contribution equation. So I can make the contribution equation as 100x plus 100y. 150y, which is given to you. Now let's down the third one, which is constraint equations. So carpentry requires, cabinet requires 3 hours of carpentry and chest requires 4 hours of carpentry. So what is the equation that I will create? I will have 3x plus 4y is less than equal to carpentry time of 4,800. Polishing will be 2x plus 6y is less than equal to 5,000. Done. So these are the two constant equations that I have. One more constraint is there, that the production of cabinet is capped at 1,200 units. So production of cabinet is x. X is less than equal to 1,200. It cannot go beyond it. X and y are 0. So we have created the different variable equations also. Now in equation 1, how would you get the coordinates? Because you need to do the plotting on the graph. Plotting on graph is not needed in your exam because plotting is not needed. But the steps, if are asked, you should be knowing how to do it. When you do the plotting, you would always take one variable as 0 and the other you equate. So in this equation, let's say first equation, I'll take x as 0, then I will get the value of y. Take y as 0 and get the value of x. By this, we will draw this line, the first equation line. Second equation line will also be drawn likewise, and you can draw the two constraint lines. Third one is very clear. On the graph, we always do equal to signs. Okay. So on the graph, I will draw 1,200 as a straight line. X is equal to 1,200. So that will be drawn like a vertical line. Clear? Now look at the graph here. So with the coordinates that was given, I drew equation 1 here. I drew equation 2 here, and this is the X equation. Three equations are drawn. We know that it is a less than equal to constraint. That means we need to produce less than on the less than side. By this, we calculate the common area, and common area becomes this. Just a minute. This is a common area, guys, that we call as feasible region. Do the plotting of feasible region, very, very essential. The plotting of feasible region is, you will see my feasible region is 0, A, B, C, D. Okay, these are the pointers, 0, A, B, C, D. Now, how do you do the next step? So, you've drawn the feasible region. Now, you need to know what is the ISO lines. See, ISO lines is, you will take any random numbers, and just try to create an ISO line. For example, I will just randomly think that maybe my contribution is equal to, let's say my contribution is equal to 20,000. I will get the coordinates for X and Y. Then take just any random number, contribution is equal to 30,000. Get the combination for X and Y. Now, when you know these combinations, try to solve it. So now let's say my equation is coming like this. Ideally, contribution line is that line at which it is touching the points. So you can see when I draw this line, it is touching this point on the feasible region. A and C are not touched. B line is touched based on the slope. So every contribution line will have a different slope. Remember it. You will, like this, you will just take random numbers, get the coordinates, plot them here. In your exam, the ISO lines are also given to you. So as per the slope only, you have to just draw the line and see where it touches the feasible region. You're unsure about it, then just solve the pointers, these 3 pointers, and do the simultaneous solving and get the optimum solution. But that is going to take a lot of time. So use the ISO line approach very carefully. Here I find that at point B, I can have a maximum contribution because this is the point at which my ISO line is touching the feasible region. So now when I solve the two equations here simultaneously, because B is the point where I have an intersection of equation 1 and 2. If B is my optimum solution point, then these two intersecting lines, no, equation 1 and 2, these will be the binding constraints. Because at B point, these will be utilized in full. So therefore, these are my binding constraints. Apart from this, any other constraint that you have, that will be non-binding. Like here, this is the equation that is non-binding. Non-binding it will be. Why? Because on this this point or the intersection of this line does not give me the optimum solution. So the intersection of the two equations that gives you optimum solution becomes your binding constraint, and leaving this, all the other lines, all the other constant equations become non-binding. Clear? And binding constraints are always utilized in full. That means not even 1 hour is extra in case of that. So if here my equation says it is less than equal to 4800 and 5000, and this is the optimum combination, intersecting lines, then X and Y are produced in a way that they use maximum full 4800 and full 5000. I don't have even 1 hour left. So if I solve these two equations simultaneously, like here I've solved it, okay, normal maths principles, I get the value of X as 880 units and Y is 540 units. Now use it in the combination equation and get the maximum contribution. Done. Now look here, I will explain you the binding, non-binding constraint fraction portion again. So if you look at my screen, my X is coming as 880 units. And what was the equation that we drawn here? That X is less than equal to 1200, which is meeting. But you can see that we still have a scope to go till 1200, right? So this is my non-binding constraint because it is not used to the fullest. Am I clear? Binding constraints will always give rise to slack, will always give rise to shadow price. Non-binding constraints will always give rise to slack. So look at my screen now. Okay, binding constraints will always give rise to shadow price. Non-binding constraints will always give rise to slack. I know it's very colorful, so probably makes it very interesting to read. And all are these my class notes that I share with my students in the class. Okay, so shadow price is the price at which I'm sorry. For binding constraints, we will have shadow price, and for non-binding constraints, we'll have slack. What is a shadow price? Shadow price means just because you have used the full hours. If let's say I want to just give you 1 extra hour of this binding constraint, that maybe I'm giving 1 extra hour of the processes that we had. Let's say I'm giving you 1 extra hour of carpentry or 1 extra hour of polishing, because both are binding constraints. So if we give 1 extra hour, what is the benefit that the entity will have? Extra contribution per unit. That extra contribution per unit is known as shadow price. That means if let's say the entity has to deliver the product and has to get that extra hour, and for that it needs to hire somebody from outside, then the maximum price that they would be ready to pay, at which the company is not into losses and not into profits also, the maximum price that the entity will be ready to pay for getting that 1 extra hour of the binding constraint, 1 extra hour, would be, here I will write down, so maximum okay, so maximum price that the entity would be ready to pay for 1 extra hour of a binding constraint, because it is fully utilized, is the cost per hour. That let's say it is labor cost, then what is the normal labor cost that we pay per hour, plus shadow price. And what is shadow price? Shadow price is okay, what is shadow price? Shadow price is contribution per unit for having 1 extra hour of binding constraint. Okay, for having that 1 extra hour, what is the contribution per unit that you are earning? That is going to be the shadow price. Am I clear? Absolutely. Okay, so this is the maximum price that the entity would be ready to pay to get 1 extra hour of the binding constraint. So this is simply extra contribution per unit. Extra contribution that the entity will earn. Now, how will I know how the company will earn the extra contribution or not? You will recalculate the equations. You will recalculate the value of x and y by taking, let's say, 4800 hours that you had earlier. You will take 4801 hours. Always out of the two binding constraints, only one binding constraint value hours will increase. Remember that. So when you equate the equation, you will do same calculations, but with 4801 hours and not 4800 hours. Accordingly, get the revised value of x and y, get the revised contribution. The total contribution, what is more than the previous contribution, is the extra contribution earned. And that extra contribution is your shadow price for a unit. With this, you will add the normal work, the normal cost that you pay to the labor, and the total will become the maximum price that the entity will be ready to pay to get 1 extra hour of a binding constraint. Clear? When it comes to slack, slack is that extra hours that the resource has. Like in our case, X had extra unit space. So that is slack. Slack means the extra capacity remaining because that particular constraint is not fully utilized, as it is a non-binding constraint. Okay? Clear? Absolutely. Question asks you, at the intersection of binding constraints or non-binding constraints, will you have optimum solution? Remember, you will select binding constraints. Clear? Great. Good. Any questions you can ask me. Now I will take the next topic, and the next topic I'm taking up is relevant costing, post which we will take up pricing. So people, any questions, any doubts? Whenever you need a break, tell me, I'll give you a break. Okay, let's do relevant costing now. One of the most interesting topics. You just have to understand the basics and then you can handle any question in the exam. Trust me. Any question can be handled. You just have to make sure that you understand the concepts. That's all. Okay, relevant costing simply talks about that you have a one-off order, for example. Okay, you just have some special order that has come up. You have some special situation that has come up. Okay, and now you need to act specially. That means it is not a regular order or the regular processes that you have. So in that case, you just have to determine what is the cost that is really relevant for that particular one-off project or that new project that has come up, because accordingly we'll decide whether we should take up that project or not. So relevant costing is only understanding about whether that project should be taken up or not. Okay, for that we understand whether the whether the product, the entity should be going into the relevant, should be taking up that project or not. So we just take into account the cost which are actually going to have a difference when this project is going to be taken up or not taken up. So that cost is known as relevant costing. Clear? Done? Okay. Okay, tell me anything you have to ask me till this point, people. Okay, then let's start doing this. So relevant costing, I'm making you understand quickly here, are the costs relevant to the decision is very important. So will the cost be affected by the decision that you take? If the cost will be affected by the decision that you take is known as relevant cost. If that cost is like the committed fixed cost, once you have incurred a rental expense, it would really not matter whether you're making one product, two products, four products, five products. Okay, because so long as the rent cost is remaining same, it is indifferent to the number of products that you are making. So therefore that rental cost becomes a non-relevant cost. Clear? So non-relevant cost or irrelevant cost is the cost which you ignore in decision making, because right now my focus area is, should I go for the production of that product or not? Should I accept that order or not? Okay, so that is where my relevant cost will come into picture and not the non-relevant cost, or we call it as irrelevant cost. Okay, now what are the relevant costs? Let's quickly look in here. So the relevant cost is here, which is, now relevant cost will help you in therefore short-term decisions. Because for long-term decisions, I'll have to take all the cost in consideration, right? For short-term profit maximization or for short-term decision making, like one-time order and all, there we take relevant costing as the base here. Okay, now, so now please look here, relevant cost has got some features. The relevant costs are the costs which are for future-oriented cost. The relevant costs are the costs which are differential cost, or we call it as incremental cost. The additional cost that you have is your relevant cost. Now, for example, this cost will include certain examples, like certain costs that will be included here are like opportunity cost. Opportunity cost means cost what? That just because you're not taking going ahead with a particular alternative and you're going ahead with the next best alternative, you're losing some potential contribution, right? So when you're going for the next best alternative, make sure that you cover up for the contribution also that you have lost because you did not go for alternative one and you went for alternative two. Clear? That's a simple, this is what opportunity cost is all about. The opportunity cost, that's simply about the lost contribution. Then your relevant cost is your future cost, like incremental cost. Yeah, cash cost. Cash cost is also relevant costing. I've explained you here. Okay, so cash cost is also irrelevant cost. That means when I go to irrelevant cost or non-relevant cost, first would be non-cash cost like depreciation, because that is simply a book adjustment. It won't really matter. See, relevant cost for me would be where I have cash outflow, because we need to arrange for liquidity also. Then the third relevant cost will be specific cost. Like if you go for a particular product, you will have a specific fixed cost to be incurred. So then it becomes a relevant cost for that decision. Because if you don't take the decision, that specific fixed cost will not be incurred. Done? Next one. So we have done opportunity, cash cost, specific cost, future cost, and the incremental cost. Yes, these are all relevant costs. Non-relevant costs are non-cash cost. Number two is like the sunk cost. Sunk cost means the cost that you have already incurred. But I have to take a decision in the future whether I should go for that particular project or not. So when I've already incurred a cost in the past, how would it matter? Hi, Hede. Hello. Okay, we are doing relevant costing, guys, and those who have joined now, you need to cover up some portions, but continue with the live session. We are doing multiple topics and doing relevant costing as of now. Okay, so now which are the non-relevant costs here, guys? Non-cash cost, clear. Sunk cost, clear. Third is the fixed cost. But now here I would like to add here which fixed cost is not relevant, the one which is committed, because the one which is specific is going to be relevant. Clear? The one which is specific is always going to be relevant. What is not relevant is the one which is not specific, which is not specific. Okay, so be very clear about it. Okay, now, so the committed costs are the costs which are not relevant. Now, why they are not relevant? Because you have already done the commitment for it. So whether you go for a decision or not, these costs will be incurred. So how would it matter whether you go for a particular decision or not? So these are not the relevant costs for that decision, right? So it is not really going to make any difference in your life, in the business life. So therefore, these are the non-relevant costs, or we call them as irrelevant cost. Clear? Absolutely. Now the next cost that I will take as not relevant is a non-cash cost, or we also call it as a notional cost. The costs that are just book entry cost, like non-cash, they are notional. Sunk cost, fixed cost, which are already committed, these are all non-relevant costs. Clear? Absolutely. Remember that when you do the decision making, only the relevant cost will impact the decisions. Non-relevant cost will not impact the decisions. Okay? Non-relevant cost will never impact the decisions. It's only the relevant cost that will impact the decisions. I hope I'm very clear with this. Okay, now let's go forward. Now the next one. Now the question comes in, ma'am, please summarize what are relevant costs. Relevant costs or the revenues are the ones that are affected by a particular decision of the management. You don't take the decision, that cost is saved. You take the decision, that cost is incurred. Like variable cost. If you make production, if you do production, variable cost is incurred. You don't do production, variable cost is saved. Clear? Done? With this perspective, now we're going to study more and more. Now, I have taken a quick example here so that we have clarity over the topic. Okay. For example, Rohan's Pizza Corner makes delicious pizza in his city. He sells each pizza for $300. One day, a client calls and says he would like to order 50 pizzas but can pay only 220 per pizza. Would he accept the order or not? For that, let's see the relevant cost here. So Rohan needs to decide whether this offer is worth accepting or not. So let's see Rohan's example. Now, he has made a current cost structure for his pizza as follows. Flour, cheese and toppings, that is like the variable cost that he needs for every pizza. The cost is 120 per pizza. Will it be relevant for him? Yes, because without this pizza cannot be made. Next is the labor cost. The labor cost per pizza is 40. Will it be relevant for him? Yes, because the workers were paid per pizza. So we need pizzas to be made, we need workers to make them. Next, electricity cost that we are using, for the oven that is running. The more the pizzas you bake, and the more oven you'll be using, and the basic packaging that you need to package the pizza. You cannot just give pizza in your hand, right? The delivery boy cannot come to you and say, "Ma'am, take the pizza, it's burning in my hand." They give you a basic packaging, and that we need. The more the pizzas, the more the packaging we need, correct? So it's your relevant cost. Now shop rent. So whether we make 1000 pizzas, we make 100 pizzas, shop rent is going to be that much only. Is it relevant? No, it is a committed cost, it is a fixed cost, it is not relevant. Next, manager's salary. Manager is going to be paid for managing the entire office. So how many number of pizzas are being made? That's got no relationship with the manager, correct? So therefore, will it really impact the decision? No, it is a non-relevant cost. And also it is already incurred. You've already entered into the contract with the manager that, look, I'll pay you 50 lakhs a year, right? So then, boss, you make how many number of pizzas, it won't matter. Done. You also get this manager's position now. Okay. Now, if you look here, what are the relevant costs that will be affecting the decision for pizza, and accordingly which will decide whether 220 offer price is worth to be accepted or not. I will not add all the cost. I will just add the three relevant costs that we saw. So I will add 120, 40 and 20. And that will make the total as 180. Now is it worth to take? You will say, yes, ma'am, it is profitable. Guys, this is the reason, or this is the way how McDonald's, for example, comes to the corporates and say that the normal burger which I'm selling for, let's say, 40 bucks, I will give it to you for 35 bucks. It is not that there's something doing, different, or they're preparing it something differently. No, they look at the relevant cost, and accordingly they find what is the relevant cost there, and according to which they give their offer price. Clear? So the decision for Rohan would be to accept the order. Okay, now let's go forward. So again, one more question, I posted it here so that we can discuss more, and I think it can give you more clarity. So number one is, this question is, a company is preparing a tender for a new contract to build a bridge. The contracts manager has spent already 40 hours researching for the contract and preparing the tender. Stop. This is the time that he has already spent in the past. So what is this? Relevant? No. It is a sunk cost. She is paid a fixed annual salary. Again, it's a fixed cost. So it is also not relevant, because no matter what you do, this cost must be borne. How much should be fixed, should be included in the relevant costing? Nothing, because this is the past cost, this is the fixed cost. So both are non-relevant cost. Clear? Great. Let's go to the next topic. Now, before I take up the next topics and make you understand the flow charts and everything, I need you to understand these three topics, these three terminologies very clearly. One is the current replacement cost. What is the current replacement cost? Guys, focus here. And if you have any doubts, you are free to ask me in the chat box. Do you remember that? Okay. Now, what is the current replacement cost that we call a CRC? That's simply the current market price. If you want to buy the same product in the market, what is the market price that you will have? Current resale value is, you have the product in a particular condition, what value it will fetch when you sell it in the market. That's simply your scrap value. Okay, this is simply your scrap value. The value at which you can sell the product and the market in the current condition. Now, what is opportunity cost? Opportunity cost is the cost that we know, that opportunity that we are losing, the contribution. Simply here I will write it very simple, lost contribution. Okay, lost contribution per unit or per hour, whatever it is, per unit or per hour, for going ahead with the next best alternative and not taking the one that is free, the one that we were about to take. Let's say what is the lost contribution for not going ahead with product A but going ahead with product B. Clear? Okay, let's go further. So now here I'll discuss the charts. I will discuss the charts from the book. Look at the first chart, guys. Please focus on my screen. My first chart says the relevant cost of material. Now let's understand this quickly. When we see the relevant cost of material, if the material is not in inventory, your relevant cost is the current replacement cost. Why? Because you will have to buy it in the market as the material is not in inventory. When the material is in inventory, now there are three situations. If your material is in continuous use, that means if you use it for your product, some other products which are being manufactured in the company will have the shortage. So you need to requip it. How will you requip it? By buying the material from the market. At what value will you buy it at? Current replacement cost. Second, if this material is in inventory but it does not have any other use. Since it does not have any other use, the only option with the entity is to sell it in the market. So what is the relevant cost for you? Current resale value. Clear? Current resale value. Why? Because if you are not using it for the product, the company will sell it in the market. So if you are using it for the product, boss, this becomes your relevant cost. Because then you are losing that scrap value, kind of an opportunity cost only. Third is, if your material is in scarce supply, that means it is not available in the market also, but you need it. Because you need it, the management needs to move the material from the one of the other products to this product. So what is management losing and what is the cost that they want to cover up? Lost contribution. Clear? So what is their opportunity cost here and what is the relevant cost here when your material is in scarcity? That is the opportunity that you are losing, and what you are losing is lost contribution. So here your relevant cost is opportunity cost. Clear? I have done relevant costing questions also in the marathon sessions. Please go through the video and go through all the questions, 130 questions that I've covered over there, and complete the questions so that you're completely exam ready. And those are top 100 section A questions, they know, that are based on the entire topics that is going to be asked in your syllabus. Make sure that you cover them. Okay. Now let's see the material and the labor and the variable overhead. Why I have categorized them into one category? Because generally the variable overheads are based on labor hours only. So therefore we place them into one category only. Okay. Now, so let's say you have a current labor force. Okay. The current labor force is there. Now, current labor force has spare capacity. You have already paid them. You are already paying them for 8 hours and they are just working for 5 hours. So they have 3 hours spare. Do you need to pay them extra for this? No, it's a regular duty to do the work in that time. So is there any relevant cost? No, there is zero relevant cost. So when the question says the labor has spare capacity, there is zero relevant cost. Now, if the labor is working at full capacity, now there are two options. Actually, there are three options. So that also I've included it here. So there are three options with the business. Number one, buy labor from the market. So what is the relevant cost? The labor cost that you're going to pay to buy the labor from the market, the current rate of pay. Next is, you ask the existing labor boss, you please do overtime. Okay, so you ask the existing labor to do overtime there. Now, when you ask labor to do overtime, what are you paying to them? You are paying them the normal labor rate plus overtime rate, right? You are paying them normal labor rate plus the overtime rate because you are asking them that, look, can you work for 2 hours extra? So if they work for 2 hours extra, they would ask the normal rates as it is. But with that, additionally, they will say, boss, pay us overtime also because we are doing your work extra beyond the working hours. So my relevant cost here will be normal labor rate plus overtime premium, which is generally like time and a half. So time is the normal rate and 50% of it is the overtime premium. Next is, now you cannot give overtime, you cannot hire labor from outside. So the other option only remaining is, boss, move the labor from the other project to this project. Again, what you are losing? Contribution per hour, definitely. But then with this, you have to pay the labor also, no, on an hour basis, since they are going to work in your project now. So now for the future period that they're going to work, you have to pay them normal labor rate plus opportunity cost also you have to cover, which is the contribution that you're losing because you move labor from project A to project B. So what is the relevant cost here? Variable cost, that is the normal labor cost per hour plus the lost contribution. Done. So we have done the relevant costing understanding for principal, for material, for labor, for variable overhead. Now, what is the relevant cost for a machinery? For a machinery, the relevant cost is the cost of repairs that is going to take place due to usage plus the fall in the resale value. What does this mean? If you sell the machine today, you will get a scrap value of 100. If you sell the machine after 2 years, because you will use it in the project, your scrap value reduces by 70. So of course, when you're recovering the cost, you will recover the 70 also, the fall in resale value, which is happening because you're selling the machine late. Clear? So these are the relevant costs that we cover here for material, labor, variable overhead, and machinery. I hope it is absolutely clear. So very important for you to see in the question is why you have calculated relevant cost in a particular way. You have to explain that why you have taken current replacement cost. Okay, why you have taken current resale value. Explain that in the question. Also in section C, as well as why you haven't taken particular figures. Explain that also. Let's say the sunk cost is there. Explain it to the examiner why you have not taken. Explain that it's a sunk cost. You will get your half marks. Otherwise, you lose it. Clear? Absolutely? Okay. Now I take up more portions here. Yeah, so now some more decisions that can be taken based on relevant costing is like minimum pricing decisions. Okay. So minimum pricing decisions. Now, what are minimum pricing decisions? Minimum pricing decisions would mean that it is the minimum price that would go for a one-off decision in its total relevant cost. Minimum price means what? You are not focusing on covering the profit. You are just focusing on covering the relevant cost. So that is the minimum price that the business would be ready to pay. Okay, minimum price that the business would be ready to pay for that particular decision. And what is the minimum price? Where there is no profit, no loss. Don't forget this. In minimum pricing decision, when the question asks you no profit, you will include it over there. Okay, and so minimum price will only cover the relevant cost and nothing else. For example, when tenders are called out by the government, then the applicant considers minimum price sometimes, so that they focus on getting more orders in the future. So first tender, they may just be doing it at no profit, no loss, so that they at least get the tenders first. Got it? Okay. Now next will be accept or reject the decisions. Accept or reject decisions means you will accept the project if there is a positive return on relevant cost, otherwise you will reject it. For example, the pizza example that we took, right? If your selling price, offer price is more than the relevant cost, you will accept it. If it is less, then you will not accept it. Clear? Okay. These are the different kind of exam scenarios that you will get, but the concept is same of relevant cost. It will not change. So therefore, I'm just explaining you the scenarios here. I will take up a quick question also for relevant costing once we complete this, so that we have a hold of the topic. Okay. Now, make or buy decisions can be there in your exam. Make or buy decisions means what? Make or buy decisions means was it more feasible to make the product in-house or to outsource it? Exactly the same question I've taken in the marathon. So please, after this revision session, quickly open your section A marathon video that I've uploaded on my channel. Open the section B marathon video and do questions from there, because with the revision and the marathon deadly combination, you will have everything sorted for your exam. Okay. Now, so what are the points to be considered when you're doing the make or buy decision? These are the pointers, especially when you're looking into theory pointers and you're writing your section C answer, you need this support. So what are the pointers? Number one, how would we use the spare capacity properly? How to use the spare capacity properly, very important. Number two, could the flexibility be affected if the process is outsourced? The flexibility of the entity, will it be affected if the process is outsourced? Next, would the delivery be on time or not? Because the company is no longer having the full control over the goods, right? As the part of this activity is outsourced. So will the outsourced person, the service provider, will be efficient enough to provide the goods delivery on time? Next, does the company wishes to retain the control or not? If yes, then outsourcing may not be a feasible option. Now, let's go forward. So generally, for what services do we do outsourcing? For example, hiring the external suppliers for finishing the products, okay, for component services. It's like a subcontracting activity that we undertake. Next major decision making is shutdown decisions. Like there are 5-6 divisions data given to you. Now the question is asking you whether prominently looks like one division is making a loss. So should we shut it down? But you will not just look at the loss and make the decision. Then what are you going to do? Look here. So here what you will do is you will focus on calculating its relevant cost and accordingly calculating the contribution that is arising. So number one, you will look at the variable cost of that division. You will look at the avoidable cost that can be avoided, because like the fixed cost, any discretionary cost, like the advertisement cost and all, if that can be avoided for that division, save it. Save that cost. Okay, we will not incur that cost. So you will stop taking discretionary cost as a relevant cost. Discretionary cost is not a relevant cost. It is not a necessary cost to be incurred. Like advertisement, even we can do without advertisement also, correct? Yeah. Then any directly attributable cost would be considered here. So let's say if a closure is made for division B, division A, division C sales are also affected by it. Make that pointer also as a part of relevant decision making. Okay. Then timing of the closure is very important, like I discussed. Sometimes when you close division B, your division A and C may just go into loss. So many times the entities carry on with the divisions, even if it is a loss-making division, because it would affect the sale of other divisions. Clear? So you will just consider the relevant cost here, focused on including specific fixed cost as a saving. So if you close it, then your specific fixed cost is saved. And your general fixed cost is not relevant, so don't consider it. Make sure that you calculate contribution in that way. If you get a positive contribution, go ahead with not closing the division. If you get a negative contribution, then just shut it down. Clear? This is your approach that you will follow. Okay, let's go further. Guys, comment in the chat box. How is it going so far? How are your energy levels? Please do the comments so that I know you are awake and you're with me. Do the commenting quickly. Oh, great. Very good. Keep the energy levels high, Anjali. Very good. Others, don't be low on the energy. Keep it super high. Right? PM is one of the most interesting subjects. And I think this topic is super interesting. Okay, let's go further. What is the further processing cost? Further processing cost is, let's say you had an operation, you have you are put into processing a particular product A, and multiple products are generated as a result of this processing. So you have product B and C that are the outcomes of this process. This process we call as joint process. And the cost incurred here is joint cost. For you, this is not a relevant cost. Why? We are looking at the point stage after B and C. And this stage at which your product gets split into multiple products is known as split off point. So my focus area is to look into the split off point and the stage after it. Now the question here says, ma'am, what if we do a further processing of it? Can we do the further processing? So the question will say, boss, you will have a further processing cost. And after this, you will have a product. Let's say the question says B can be further processed and it will become B1. Is it feasible to go for this further processing? Don't answer yes and no like that. Then what are the relevant pointers that you will see? You will see what is the incremental further processing cost after the split off point. The split off point is also known as separation point, because till the split off point there is no relevant cost. We are looking at beyond split off point. Clear? So now after the split off point, what is the incremental cost which is getting incurred? That is your further processing cost. Now compare this incremental cost with the incremental revenue. What is incremental revenue? The revenue at the split off point and the revenue at this point. This is known as final point. Okay, so get the difference between these two revenues. That will give you incremental revenue. This is giving you incremental cost. Get the difference. If your incremental revenue is more, go ahead. If your incremental revenue is not more, I mean it is less than the cost, don't go ahead with further processing. Simple. Okay, so do it this way, your relevant costing. Now, these are the basic assumptions that we carry in relevant costing. And my friends, let me tell you, very important for you for your MCQs, because in your exam, no, these are very famously asked in your true false, select the options in that menu. So what are the basic assumptions that we carry in relevant costing? Is cost behavior is in a predetermined manner only. Okay, it's always in a predetermined manner. So basically we say that variable cost is constant per unit. Okay, and yeah, variable cost is like, for example, it is constant per unit, and the pattern of the cost will be same whenever whatever decisions we take. So even if, see what happens when you take a new order, your pattern of cost may differ, correct? But we don't take that assumption here. We assume that whatever was the pattern of cost for the existing orders will be the same for the new orders. So that's a very big difference for relevant costing. Then CVP, cost, volume, profit will remain constant, and we know them for sure. But future is uncertain. So here we don't include probability angles, and that is a very big disadvantage. Then aim is to maximize the profits just like any other businesses. That's all. Done. And like I told you, joint costs are the sunk costs, so they are never relevant cost. Clear? Let's quickly look at one question so that we have a hold of it. Let's go to the book and let's just take one question that I will just explain you with the solution. Okay, so here I am taking this question number 4. Okay, now look at my screen. Emmerdale has been asked to quote a price for a one-off contract. The following information is available. Material is, the contract requires 3000 kg of material K. The company has 2000 kg already in stock that was purchased last month for 19,600. Is this relevant? No, it is a sunk cost. Current market price has increased by 5%. Okay, so we need 3000 kgs of material K. 2000 kg is in stock. Current market price has increased by 5%. So first I need to buy, I need 3000 kgs, right? Now understand, this was the cost that we incurred long time back, but now the price has increased to 5% more. So you will take 19600 multiplied by 105%. You will get your current price. Now this is the price for 2000 kgs. What is the price for 3000 kgs? So this divided by 2000 multiplied by 3000 will give you the cost for entire 3000 kgs. Nothing mentioned means we'll have to replace it with the market price only. So current replacement cost will be my relevant cost here. So here my relevant cost will be then 30,000. Done? Clear? Any doubts, any questions you have, you can ask me, guys. Okay? Next one. The contract also requires 200 kgs of material L. The company has 250 kgs in stock, not needed for normal production. That means it will be scrapped. So if unused material L can be sold for 11 per kg. This is my relevant cost, because if we are using it in the project here, then we are losing 11. So what is the relevant cost? 11 into 200, because we just need 200 kgs is your relevant cost here. Clear? Let's go to the next one. The contract requires 800 hours of skilled labor, paid 9.5 per hour. Skilled labor is limited. That means scarce. You need to buy the labor. But here it says that currently it is used in product P. The question is not given any other information, so we assume that there is no lost contribution, or even I can just create it. Okay, let me give you one just a kind of a hypothetical point here. Let's say that the lost contribution is 10 per hour. Okay, and here my cost is 9.5 per hour. So for me, then the relevant cost will be, okay, I'm sorry. The details are already given to you here. It's given here, selling price is 60, variable cost is 38, other cost is 22. So 38, other cost is 22 and selling price is 16. So I am getting here, my contribution is 0. There is no lost contribution. It cannot take place. Let's take the skill labor cost as 30. Okay, I'm just assuming it here. So if I take it as 30, it is 30 and 30 minus 22, I will get here 8. So I am losing a contribution of 8 per unit. I will add here 8. But then our data will not be there. Okay, leave it. Leave it normally only. So it is 0. Contribution lost is 0. So here you will add 0. So the relevant cost will be 800 hours multiplied by 9.5. If it was contribution was there, then we would have taken contribution also. Now you add everything and you get your relevant cost. So the relevant cost here is 40670. Done. But I hope the current replacement cost, resale value, everything is clear to you. Okay. Yeah, so that's all. We're done with relevant costing, one of the most prominent topics of your PM syllabus. And I'm sure you have got the hold of it. You have got the understanding of it. Please go to your marathon sessions. I'm sorry I'm telling you repeatedly for this because 130 questions that we have solved over there. Trust me, guys, a lot of relevant costing questions also have taken over there. And a section B question also is on relevant costing, wherein I've taken in detail for material, labor, all the areas. Okay, so don't miss out on that in case if you're not yet covered it. Okay, let's take the next chapter. But let me just see what all topics we have covered for today. We have covered relevant costing, limiting factor analysis. Now only 3 topics are remaining for today. That is pricing decisions, risk and uncertainty, and quantitative analysis. Let's complete them as well. So let's take up the pricing decisions first. Okay, let's take up the pricing decisions. Okay, guys, be with me on my screen, and I hope my screen is completely visible to everybody. Now, pricing decisions. Doesn't matter till what time we are going to be covering it, but I'll cover these 3 topics for sure today. Pricing, quantitative, and risk and uncertainties. Very, very, very important for your exams. Okay? Now, let's discuss here. So the pointer here is how to set prices for the product. So what is pricing decisions about? How would you set prices for your product and your services to optimize the business performance? This is the target, to optimize the business performance. So how would you set the prices? This is the entire chapter is only about that. Now, first thing you have to understand is that demand and price are always having inverse relationship. Demand goes up, price goes down. If your price goes down, demand goes up. Price goes up, demand goes down. This is the inverse relationship typically we have. But not every product will go in this fashion only. Your price goes up for iPhone, your demand goes up for iPhone, right? So this is also a situation where we have. So elasticity of demand helps us to measure. If I say my demand is elastic, okay, if I say my demand is elastic, It would basically means that basically when a small change in price leads to a bigger change in demand, then we say your demand is elastic, and we say it is an elastic demand. For example, if the price of a designer bag increases, then the customer are more likely to buy the cheaper collections, right? Majority of the customers. So with a small change in price, the demand affects largely. That is, we say that the demand is elastic. It is responsive to the price change. When I take the inelastic demand, now the demand is inelastic to the price change. It is not responsive to the price change. Apple iPhone is the best example for this, please. So here a small change in price generally either does not cause any change or causes a very minimal change in the quantities demanded. Clear? So please understand elasticity of demand very, very effectively. How do you measure elasticity of demand? Elasticity of demand is measured as percentage change in demand divided by percentage change in price. Understand that elasticity is always measured in percentage. Percentage change in demand by percentage change in price. Because we always see what is the effect in demand as a result of change in price. Clear? Great. Okay, let's go forward. Next is, what is the optimal pricing? See, optimal pricing is the best pricing method is that method which gives us the maximum profit. Okay, so for this, determining the price, which is the optimal price, step 1, calculate the demand equation. Demand equation is P is equal to A minus BQ. Okay, demand equation is P is equal to A minus BQ, where A is the price, the maximum price, and that we say theoretical maximum price. Why? It is generally in the books only. Practically, you don't have that price. It is that maximum price at which your quantity demanded is 0. So this is like the maximum a price can go. Okay, theoretical maximum price at which your quantity demanded is 0. So that is your A. A is that. What is B? B is the slope of the demand curve. That simply determines how the demand equation curve, is going, demand price relationship. So now what is B? How do you calculate it? B is simple. Change in energy. I'm sorry. Change in price. Change in price divided by change in demand. And understand it is not in percentage. Come on guys, you can give me smileys for it. Okay, now here we have B. B is the slope. Slope basically is determined by change in price by change in quantity. We don't take percentage, okay? Remember that. We take absolutely in absolute values. There are small differences that pay attention to it. So change in price by change in quantity. Clear? Now, what is Q? Q is the quantity demanded at the price. And this is the most optimum price that the product should have. So this is the equation that we have. P is equal to A minus BQ. P is equal to A minus BQ. Don't forget this demand equation ever. Okay. Now the next is, ma'am, why are we doing it? Because sometimes you will be given quantity, you have to find out price. So this is the price equation that you will use to find out. Okay. Now remember that by using the optimal pricing at that particular selling price, the short-term profits are the ones that can be maximized. For maximizing, we will use marginal revenue is equal to marginal cost equation. So for that, first equation is always the price and demand relationship that we have done. Now let's take a small example here. If the current price is 12, at this price, the company sells 60 items a month. 1 month, the company decides to raise the price to 15, but only 45 items are sold at this price. Formulate the demand equation. So for that, calculate A. A is not given to me. So we will work out A. Okay, but because we have the pricing levels given, for that, please find out B. B is the change in price by change in quantity. Okay, what is the change in price? Change in price is 15 less 12. Change in quantity is 45 less 60. You will ignore the negative sign. So you will get here B as 0.2. You know B, one of the relationship you take, for example, I will take P is 12, Q is 60. this relationship. Now in this demand equation, find out the value of A. You equate this, calculate it, you get A as 24. Now I know my demand equation, which is P is equal to 24 minus 0.22. So if you know quantity, you can get the optimum price. If you know price, you can get the quantity. Simple. Done. Creation of demand equation is very frequently asked in exam. Very good, Anjali. Perfect. Very good. And good that you are very, very attentive in the class. And others also, I'm sure you are following the same track. Very good. Okay, let's go to the next one. Now I go to the next step. So step 1, when you determine the profit maximizing price. Step 1 is to create the demand equation like we did. Step 2 is to create the marginal revenue is equal to marginal cost equation. What is marginal revenue? What is marginal cost? Let's quickly have an understanding of it. Marginal revenue is simply increase in the total revenue as a result of selling one additional unit of the scarce resource. So the increase in total revenue as a result of selling one additional unit of the scarce resource gives me marginal revenue. And what is marginal cost? Just like that, it is simply the variable cost of making one unit, because variable cost is that additional cost, right? So marginal cost is always equal to the variable cost, always. Let's take in just a more detail of it. So in order to sell one extra unit beyond the units which are demanded at a production, at a particular selling price, there is a need to reduce the price, right? See, right now I'm selling 100 units at a price of 10. If I want to sell more units, let's say I cannot sell more units at the price of 10. So if I want to sell more units, then I need to reduce my price, correct? So there is a need to reduce the price for all units then, henceforth, which will reduce your overall total revenue. So when you calculate marginal revenue, you will always see generally a decline in the revenue. And when you calculate marginal cost, we will, for simplicity, we will always assume that marginal cost is equal to variable cost per unit till the full capacity is reached. Generally, it is constant, but the cost per unit will reduce if any volume discount is given. Because the more units you manufacture, economies of scale come in, so the cost per unit gets reduced. Clear? So remember, when we see, I will show you in a tabular formula, approach also. When we have MR and MC being there, that for every incremental unit that is being sold, the per unit revenue actually goes down, right? And likewise for the cost, because then economies of scale comes in. Clear? So now you will always use this equation MR is equal to MC, where MR equation is just like demand equation, but instead of BQ you use 2BQ. So MR is A minus 2BQ, okay, and MC is variable cost per unit. You equate it and you can get the values. I will show you in the example. So understand that your profit maximization will take place where MR is equal to MC. And always remember it. I mean, you cannot afford to forget it. If you have to calculate MR is equal to MC, step 1, find out the demand equation. Then step 2, equate MR is equal to MC. But first, demand equation is much needed for you. So identify the quantity of sales at which your profits are maximized. Okay, and accordingly, so when we equate MR is equal to MC, guys, understand, when I equate MR is equal to MC, what I am doing effectively, I am doing A minus 2BQ, sorry, at MR is equal to MC. I am doing A minus 2BQ is equal to variable cost per unit. So you know A, you know B by the demand equation. You can work out Q here as the balancing figure. Once you work out Q, go back to your demand equation, replace Q there and find out the price. So that price is the price where your profits are maximized. That's how we do this 3-step process. Demand equation, MR is equal to MC, go back to demand equation. Done. Okay, remember these 3 steps. Now, let's say the question says that there is volume-based discount given, discount is available for bulk purchases. Then question will say, Please work out that whether it is financially viable or not. Should we give volume based discounts or not? Is it really viable or not? So what are the steps that you will follow? I have given you the summary of steps here with an example. So look here at my screen. Number one, calculate what is the increase in total sales as a result of this volume discount. Okay, because volume discount means more quantity being sold. So due to the change in quantity, what is the final selling price and the selling price difference also? Now you will be selling at a lower price but more quantities. So what is the effect on revenue? Calculate that. Number two, calculate the increased cost. An increased cost will be change in quantity multiplied by variable cost, correct? Because that is the only cost that we will consider it. So calculate incremental revenue, calculate incremental cost, get the difference. If your step is positive, you will accept the volume discount. If your answer is negative, don't accept the volume discount. Clear? So majorly, entirely in your PM, I have summarized the steps into 3-step process so that you will never forget them. Okay? Yeah. Now let's go forward. A company sells a product at a price of $10 per unit. The variable cost is $4. Volume discount is offered at 5% for buying at least 5,000 units a year. The customer will increase production from 4,000 units to 5,000 units per annum. Calculate the effect on profit. First step, calculate the increase in selling price or total revenue. So my revenue earlier, the price was 10. Now it is 5% less. That means it is 9.5. Quantity has increased from 4,000 to 5,000. Get the difference? You get an incremental revenue of 3,500. Now let's get incremental cost. Okay, incremental revenue is 3,500. What is the increase in cost? I'm sorry. Incremental revenue 7,500. My bad. And what is the increase in cost? You can say the number of quantities that have increased 1,000 multiplied by variable cost is 4. So incremental cost is 4,000. Net incremental profit is 3,500. Go ahead with this volume discount because it is profitable for the entity. Done. Done and dusted. Clear? Okay, let's go forward. I will just quickly take up a small example for MRMC and then we take up the pricing strategies and done with the chapter revision. Then we go to the next chapter. Okay. Okay. So look at this. Okay, I'll just show you the graph also here, guys. Understand that this is the graph for marginal revenue and cost. So this is the point at which your marginal revenue is equal to marginal cost. So this is the profit that you get. This is the profit maximizing output and this is the profit maximizing price. Don't forget that because this is the demand equation. So this is the profit maximizing price and this is the profit maximizing output. I will show you in an example how do we work out them. Okay, can you see this table? Right, so this is the table. That is a tabular approach also. Sometimes the question will ask you to please calculate the profit maximizing price. So here, let's say if I'm finding out the profit maximizing price. So if you look here, my revenue is falling. Revenue is falling. And where is my profit maximized? My profit is maximized at the point where MR is equal to MC. So my cost is also, the total cost is rising here, but the per unit cost is there and selling price is falling. Since your selling price is falling, this gives you an indication that you're selling more quantities at this point. So MR is equal to MC at this point, your profit is maximized. Clear? And when we do the equations, I will just show you the approach. Step 1, calculate the demand equation. Yeah, calculate the demand equation. Then you calculate MR is equal to MC, find out the value of Q, put it in demand equation again, and find out the value of P. This P is known as the profit maximizing price. Okay, just to give you an idea about it. Now let's discuss the pricing strategies. Pricing strategies are what are the different strategies that the business can adopt in order to have the maximum profitabilities. I'll give you quick tips to understand every pricing strategy. First strategy is cost plus margin. Full cost plus margin approach that is generally important for your long-term planning. Full cost plus margin means get the full cost, add the profit margin, and you get your price. Normal approach. Okay. So for example, full cost is you will take the variable cost, fixed cost, add it, get the total cost, add the markup, and get the selling price. So full cost plus margin is always relevant from long-term planning. Don't forget that. Now, marginal cost plus pricing approach means you are just aiming to cover your variable cost. So here your pricing will depend upon variable cost. And remember, when you take variable cost, common mistake done by the students that they always take into account the production variable cost. No, I am saying variable cost. So whether it is production or non-production, you will add the two and add markup to it. Okay, it is a short-term perspective pricing approach. Then we have in return on investment pricing. Now this is again a long-term approach for pricing. Now what is return on investment pricing? That simply says you will have a full cost, but with this you will not add your profit margin. Then ma'am, what will we add? We will add what is the return on investment that an entity expects from the investment that they have done. Add that investment to the cost, and then that becomes your pricing. So with full cost, you will add the return on investment percentage that is multiplied by the capital invested into production. So the entity has invested capital into production multiplied by the return that they're expecting to achieve. And that becomes the profit levels that you will add to the cost. So this is return on investment approach. Clear? Simple? Okay, if you want, I have taken a quick example here to make you understand the three pricing strategies. I think we can take it quickly here to understand that so that we have utmost clarity. Investment in production is required, that is 2 million. Working capital required is 2 million. Okay, this is for the working capital requirement. So it is 10 per unit per annum is there. 10 per unit is given to you here. Investment in production required is 2 million, and working capital required is 10 per unit per annum. This is the requirement. Expected sales volume of 40,000 units. Variable production cost is 30 per unit. Fixed production cost is 300,000. Non-fixed production cost is 100,000. Calculate selling price using the full cost plus margin where it is 20%. Get the full cost. How will we get the full cost? Full cost will be variable cost, which is 30 per unit. And fixed cost, see, I am calculating everything in per unit. Okay, because we need per unit calculations always in the pricing approach. So now fixed production cost plus non-fixed production, add it. Divide by the expected number of units, you get it at 10 per unit. Total cost is 40, markup is 20. So here you get a selling price of 48. Done. Next is marginal cost plus markup approach. Marginal cost is only the variable cost, which is 30, which includes all the variable cost plus markup of 12, which is 40% of it, and selling price will be then 42. Done. Then next is return on investment approach. That is always full cost plus return on investment. Full cost we had calculated here 40, so that I will take here 40. What is the return on investment needed? We need a return on investment of 2 million plus working capital required is 10 per unit. Units are 40,000. 40,000 into 10 is 400,000. 20 plus 4 is 400,000 divided by multiplied by 10% because return on investment needed is 10%. So 2400,000 multiplied by 10% gives me 240,000. Now divided by 40,000 number of units to get the per unit profit. Per unit profit return required is 240,000 by 40,000, which is 6. So total here my pricing will be 40 plus 6, which is 46. Done. Are we clear? Absolutely. With the full cost approach, margin plus margin approach, marginal cost plus margin approach, and the third one, return on investment approach. Right? Any questions? Put it in the chat box. The next is opportunity cost pricing. Now, guys, tell me quickly. What is opportunity cost here? The relevant cost. So you go back to your relevant cost topic and add markup. Next question you guys are doing. Okay, so relevant cost is the minimum price that can be used as a basis for a quotation. And with that, we will add markup. Life cycle cost pricing is there. That means we'll add life cycle cost plus margin. If it is needed, margin, otherwise you'll take total life cycle cost. Now the next one. What is the market skimming price strategy? Market skimming iPhone, don't forget. Whenever market skimming is there, remember iPhone. What does iPhone do? It enters into the market at high price, tries to grab its entire profitability within a short-term duration, and then it substantially reduces the price. So market skimming is the strategy where the product will enter into the market at higher price when the new product is launched in the market, so that short-term profitability is maximized. And in later stages of the product life cycle, the lower price is charged, because practically they've already covered their profits till that time. Now market penetration, remember Geo. Okay, because Geo what it did, it entered into the market at very low price or free cost and grabbed the maximum units. So thereby it really made its competitors have a tough time. So market penetration is opposite of market skimming. It is launching a new product in the market at a very low price to obtain and create demand for that product. Third is price discrimination. Price discrimination is you go to zoo and they say the children aged less than 10 years are priced at 20 per ticket. The normal adults are charged at 30 per ticket. Senior citizens at 15 per ticket. So that is pricing different categories or different type of customers for a different price. So selling in 2 or more separate markets, for example, at different prices. Comprehensive product pricing is, complementary product pricing is razor and blade. Okay, razor and blade are interdependent on each other. Razor needs blade, blade needs razor. So here is razor is charged at a very low price, blades are charged at a very high price, because razor cannot work without blades. Hence, this is known as complementary product pricing. So basically, as the use of one product is linked with the use of another product, hence the input of a price change in one product will have the impact of a price change in one product will have an impact on the price change of will have an impact on the demand for the complementary product. Okay, it will have an impact on the demand of the complementary product. Clear? Like in cartridge and printer also is the example. Product line pricing. Product line pricing is you go to McDonald's and you order burgers. If the price is increased, all burgers are increased for their prices. Okay, price of all burgers are increased. That is known as the product line pricing. So when a pricing policy is applied to not just one product but to the entire group of products in that particular product line, and as they are all interrelated to each other. So for example, sold to same customer, or you're selling to the same outlet and setting differential prices between the different products in a range. Okay, this is okay. And for example, yeah, product line pricing is also like you go to the different versions of the car, right? So you go to a basic version and then as the versions increases in the same category, differential prices charged. So this is a product line pricing that is covered here. Done. Next is volume discounting that we have already covered in one of the questions. That is when you have a promotional policy and you give a policy like that, when you buy one product, let's say it is for 100, and the next product will be available at a lower price. Lower price means 50% off. So that is known as promotional pricing. Okay. This is to offer a competitive price overall. By offering these discounts, the customer is tempted to buy the second one, because then you're tempted. If you buy the second one, you will get 50% off. Right? So this is the volume discounting or the promotional pricing. Clear? Now comes the very important pointers, loss leaders, Loss leaders are like you go to a supermarket, or let's say I'm dealing in 10 products. One product is always generally a loss making product for me, but that is an attractive point for the customers. Customer comes and buy only one product, but I have to keep 20 products in my inventory. But because they buy one product, this one, they instead buy 20 other products also. So this loss making product is giving me 20 other products revenue where I'm charging full value. And this product which is attracting customer, I am charging it at very low value. Let's say I enter a departmental store and I say potatoes are available at only £1 or only $1. So people are attracted to come and buy potatoes, but when they come to buy in the departmental store to buy potatoes, they also buy other products wherein I charge good profits. Okay, so this is known as loss leaders. And if it is, it means that it is sold at a loss to attract customers who will then buy other products, like the supermarket example I gave. Next pricing strategy is going rate pricing. Going rate is whatever is the market price will charge you that. You go and buy gold, you go and buy the airline tickets, you go and buy the train tickets. It's the same fund. So charging the price which is prevailing in the market. And generally it is the price that we take in the competitive market. Clear? That means if you charge the price more than what is prevailing in the market, you're going to lose the customers. And even if you charge lower than the market price, it is not going to make much difference for the customers, because the customers are indifferent towards it. And as it is, you can also not charge lower than this, much lower, because it's a market competitive price. In order to survive in the market, you will have to charge a market pricing only. Just a small 5-10 variation may be done, but that won't really attract a lot of customers. Clear? Okay, so now here I have just given you the summary of steps to be followed when you look for maximizing the selling price, because it is a question that you will definitely expect in your questions, in your exam. Number one, formulate the demand equation. Number two, formulate the MR equation. MR is equal to MC equation. Third one, go back. Third one, in that MR is equal to MC, find out the quantity, Q. And now you put the quantity in your demand equation and find out the maximizing price. That's all. I hope your pricing chapter is at most clear to all of you with no confusions and no doubts. Tell me your energy level, guys. Ready to go ahead with 2 more chapters? Tell me quickly in the chat box. Let's take up risk and uncertainty. Tell me quickly. Should we go ahead? See, I'm giving you such colorful visuals so that you are there in the session. Should we go ahead with this? Give me a thumbs up. Give me a thumbs up for the same. That yes, ma'am, we are having energy levels. Or do you want a break? Tell me. Should I give you a break or should we continue? Put that in the chat box quickly. Okay. 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 So let's have a break. Let's have a break. Though my timer will show you 10 minutes, but let's have a break for 5 minutes. Okay. Let's resume in 5 minutes, everybody. Hey guys, give me your attendance. Who all are there? Just say yes, ma'am, so that I know my class is having high levels of energy here. Okay? Revert. Who all are there? I hope you have not gone, all of you. Should we resume? Okay, thank you. Yes, let's resume now. So I am discussing the second last topic for today, which is risk and uncertainties. So focus here, one of the very tested topics, especially for section A, very much tested topic. Okay, yeah, what is risk uncertainty about? I've given you this flowchart so that we know about it, right? Uncertainty definitely knows that you know about the outcomes. Uncertainty means you don't know about the outcomes, and that gives rise to a lot of risk, lot of probabilities. Clear? So risk and uncertainty is about that you, when it comes to risk, you, risk means that you can estimate your future with certain probability measurements. Uncertainty means you don't know what will take place in future, so you cannot apply probability. Common MCQ question which is asked. So with uncertainties, typically I cannot assign probabilities, but with risk, yes, I can assign probabilities. Risk means I know that there is an occurrence of a loss maybe. Okay, so we can just estimate the loss with the different probability estimates that I have. Got it? So risk is something that can be measured, that can be managed, that can be mitigated also. Okay, for the potential loss. But uncertainty is something that you need to make a contingency plan for, because you don't know what will take place in the future. I don't know whether corona will again come or not. I really don't know. I cannot make a prediction, but I can make a contingency plan that in case if corona comes, then what are the steps that we should be taking. Okay, so this is what uncertainty is about. Clear? Now there are three types of risk. There are three types of attitudes towards the risk from the three different types of people. First is a risk taker, the ones who would always go for high returns because he would expect that high risk, high returns is the match. The next one is risk averse person. He is a very conservative person and he's something who is offensive of risk. He doesn't want to take risks. So he's somebody who will say that, okay, give me the options and tell me the minimum returns. From these minimum returns only, I will take the option that will give me the maximum returns. Okay, so he's not a risk taker. So he's happy with the FD returns, with the minimum returns that he's having. Okay, so I will say that he is generally happy with the minimum returns. Okay, now risk neutral person is, he is in the midway. He doesn't want too high risk, he doesn't want too risk, low risk. So he would safeguard himself with the help of probabilities. So how would he calculate risk? With the help of probabilities. So remember, a risk neutral person will always use probabilities to arrive at the final conclusion. Clear? Now, for example, let's take an example just to make us understand the perspective of the three different types of risk takers. So let's quickly take that example here. So here I'm taking, let's say the expected profit for project A is 10,000, expected profit for project B is 10,000. Okay, now if he is a risk taker, he would go for, how we got the expected profit? This is with the use of probabilities. Okay, with the use of probabilities, I've calculated this. I'm not doing the calculation, I'm just showing the final outcome. If he's a risk taker, he would go for highest possible profit. Highest possible profit of A is 20, B is 11. So which is the one that gives him the highest possible profit? Maximum of these. Maximum of the maximum is 20,000. So he would go for project A. Why? Because maximum returns of the two projects, he would go for maximum of the maximum. That we call as max. Maximum of the maximum returns. Got it? If he's a risk averse person, he would go for maximum of the minimum returns. Minimum returns here are loss of 10 and profit of 9, which is the maximum of this minimum 9,000. He will go for project B. Now, if I see expected profit, let's say I get 10,000 only both sides, then he's indifferent. He would go for any of the projects. Okay, he would go for any of the projects, maybe considering other factors also. Clear? So this is the difference between risk neutral, risk averse, and risk taker. Now let's discuss here how would you counter uncertainties. In your exam, you will get how would you counter uncertainties, my friends. So uncertainty can be countered with the help of market service, with the help of feedback on the products obtained from the customers, because that would give us a fair idea, kind of what are the customers expecting in the future. Then we can have the uncertainties being settled with the help of focus groups. That is, you will have some groups and you will just have interviews of those groups, and based on the final decision or the inputs, the thought process of that group, you will create a thought process that typically what is the situation going to be there in the future. Clear? So this is the focus groups. Questionnaires are something which is given to the customers, and based on your feedback you draw down the future outcomes. So that is definitely the situation when you're launching a new product, because you don't know how your customers will react to that product. So in order to safeguard yourself, you do these pre-steps so that when your product is launched, it is generally acceptable. Then sample distribution that we do free of cost, so that the customer's acceptability increases. Done? Okay, great. Now, what are the methods examinable for you in the exam? Expected value method, decision tree method, value of perfect information, maximum, minimum, yeah, maximin, maximax, and minimax regret evaluated. I have done a lot of these questions. I have already covered them in section A and B marathon sessions. So in case if you have not covered, please go through these sessions and cover them. You will find practical questions which I have solved over there. Now, what is expected value method? So let's take an example here. See, expected value method is we are considering the situation with the probabilities. Let's say I have a situation to consider whether it will be raining or not, and we use probabilities here. So or let me just say there are three projects, mutually exclusive projects are there. Okay, there is a situation when there is high demand, moderate demand, and low demand. So the profits that I expect in high demand is 10,000. Profits I expect in moderate demand is 8,000, and low is 6. Here it is 9, 5, loss of 1,000. Here it is 20, 2, and loss of 1,000. Okay, the probabilities are given to you 0.5, 0.3, 0.2. That means there is a probability of happening of high demand, of happening of moderate demand, and of happening of low demand. Now, what project should be accepted? The project with the maximum profit should be accepted. But then we will follow expected value method here. So how would you do for A, for B, and for C? Look here. For A, high, moderate, and low. Now look here on my screen. 10 multiplied by 5. I will use probabilities. So 10 multiplied by 5 will give me, okay, 10 multiplied by 0.5 will give me 5,000. 8,000 multiplied by 0.3 will give me 2,400. This is only, let's see the maths. 8,000 into 0.3. 2,400. 6,000 multiplied by the probability of 0.2 will give me 1,200. Likewise for B we can do. Now here I will do 9,000 multiplied by 0.5 will give me 4,500. 5,000 into 0.5, 0.3 will give me 1,500. 1,000 loss multiplied by 2.2 will give me 200 loss. When we go for C project, 20,000 into 0.5 will give me 10,000 profit. 2,000 into 0.3 will give me 600 profit. Negative 1,000 into 0.2 will give me 200 loss. Now let's just check them and see which option gives you the maximum profit. Add the 3, 5,000 plus 24 plus 1,200. 5,000 plus 2,400 plus 1,200 gives me 8,600. Then 4500 plus 1500 plus negative 200 gives me 5800. Then 10,000 plus 600 less 200 gives me 10,400. So while using the expected value method, we would go ahead with project C as it gives us the maximum return. Clear? Okay, now let's go to the next one. The decision tree method that I've already covered and that uses expected value method. For this, please see my section A and B marathon where I've included a question over there for decision tree. Okay, now I'll discuss the value of perfect information. Okay, now when we discuss the value of perfect information, in fact, I can also discuss one more point, that what are the advantages and disadvantages of expected value method. Guys, what are the advantages and disadvantages of expected value method? Number one, it is easy to use. Number two, it will be difficult to assign probabilities and it is very much subjective, right? And you cannot be always certain about the probabilities. Next, it is highly subjective. Like I said, an average method is the one that reduces a dependency on only one figure. So we use averaging so that we leverage our risk, we mitigate our risk. It's a very good method to use. Now let's discuss the decision tree approach. One thing that I want to cover here, yes, section A and B marathon, I've taken the question over there, but few pointers I would like to cover here is, okay, that number one, the decision trees are always created. Few pointers, please note. Number one, decision trees are always created from left to right, but we evaluate them from right to left. Like this we evaluate, okay? Evaluate them from right to left. These are few tips that you don't forget. Number two, when you find these type of boxes in decision tree, it is a decision box. That means you will take a decision. Either you select product A or you select product B, or you select option 1 or option 2, like that. So it's a decision making box. Then you have this option. This is a calculation box where you will do the calculations. Okay, you will do the calculations. You multiply probability and all, and you do the calculations. Clear? Now, one more point. What are the advantages and disadvantages of decision tree? Just like expected value method, the same ones would be there. The advantage is that you're using expected values to solve the different scenarios, and it of course gives you more confidence, right? More confidence because you're using probabilities, you're mitigating the positions. Number two, it is more easy to use as everything is visually in front of you. So it is more easy to use this approach, and it gives you clear-cut differentiations also visually when you see it. Now next, value of perfect information, highly important. And what does this mean? Let me give you a background of it. Value of perfect information. Perfect information means that, boss, I want to know. Let's say we had the three situations in project A, B, C, right? I want to know perfectly in project A, I will go ahead in high demand, which project we will choose. In moderate demand, which project we will choose, and in low demand, which project we will choose, and that is fine. In order to get that level of accuracy, you will have to do expenditures on lot of surveys, lot of other market data to be collected, and that is not free of cost. So we here check, is it really worthwhile to get that perfect information? If yes, what is the value of that? And that is what we call as value of perfect information. Okay, so here what you do is, how do you calculate value of perfect information? Look here. So the value of perfect information is equal to what is the expected value of perfect information, and from this I will reduce what is the expected value of imperfect information. Okay, you got the value perfect, the expected value. I'll show you in an example. Don't worry, I'll quickly solve it also. Expected value of perfect information, expected value of imperfect information. That difference gives you value of perfect information. So what is this value representing? Guys, what is this value representing? It is essentially the maximum cost. Maximum cost that can be incurred by the entity to obtain the information. Okay, so it is the maximum cost that can be incurred by the entity to obtain the information. Maximum cost. Why? See, if you incur more than this cost, then it is no longer beneficial, no, because the value of expected information, a perfect information, and the expected value of imperfect information are less than this. So why to incur more than this? You do a CBA, cost benefit analysis. Now let me just show you with an example, then we'll discuss advantages and disadvantages. Now the same example I take here. If I have to calculate what is the expected value of perfect information, and what is the expected value of imperfect information. Imperfect means I don't know what will be the correct option. So like here the expected value method, I have chosen C. So 10,400 is the expected value here. Because we have applied probabilities at all points, I don't know which is the best option that we will take. So I have gone ahead with this. Now when I say expected value of perfect information, how would you calculate? So look here on my screen. Now I know when the demand is high, I am going to go ahead with C only. This is for sure we know about it because it is going to give me the highest value. So we will go ahead with C when demand is high at 10,000. When the demand is moderate, then I will go ahead with 8,000. C is 20, I'm sorry. When the demand is low, then I will go ahead with 6,000. Now multiply the probabilities over here because now I certainly know in high demand which project I am choosing, in low demand what project I am choosing, and in moderate demand what project I am choosing. Now just simply multiply with the probabilities 0.5, 0.3 and 0.2. So what is the value that you get here? That will be the expected value of perfect information. Let me use my calculator. So 20,000 into 0.5 is 10,000. 8,000 into 0.3 is 2,400. 6,000 into 0.2 is 1,200. Let's add it. So 10,000 plus 2,400 plus 1,200. I get here 13,600. So if I have the perfect information available, I'll go obviously with the highest project, right? Highest profit making project. So here I get value as 13,600. Now what is the difference? The difference is 13,600 less 10,400. I am getting 3,200. So this is the value of my perfect information. That means as a business, we will not do expenditure more than this. Why? There is no use. Because you make an expenditure more than this, it is not going to benefit the entity. Maximum you can only reach to 13,600. If you do more expenditure, you will end up into losses. So therefore, don't do this. Okay? I hope I'm very clear. I'm making a simple payoff table because we need to just understand the concept. So this is my supply order. First I will take demand. So this is my demand and this is my supply. My supply is that you can supply an order size of 20, 40 or 60. This is my order size. And this is the orders demanded. When my orders demanded are orders demanded can be 20, 40 and 60. Now based on the probabilities involved, if there is any, I have calculated the payoff. Payoff means profits. Okay, let's say what is the profits involved here. No probabilities, profits I'm giving you directly. This is the payoff table. Okay, now I'm giving you the profits that if the order size is 20, the profit here is 10. Okay, and it will remain 10 only because even if the demand gets more, I cannot provide more than 20 orders. So in all cases, it will remain 10 only then. If my order size is 40 and the quantity demanded is 20, let's say my profit is 25, here it becomes 35 and it will remain stagnant. Why? Because if my order size is 40, quantity demanded is 40, my full order is getting met. If my order size that we can supply is 40, even if the quantity demanded is 60, I cannot meet the demand levels. So my profit will remain fixed at 35 only. Because at max, we can sell 40 units only. Third one, let's say that here my order size is 16 and the payoff is 15 here 38 and here 42. I've done the calculations and I'm just including it here. Now let's see the approach. If your if the person is a risk taker, if the person is a risk taker, then what would he prefer? He would prefer the maximum returns of the maximum returns that are there under each of the order options. So he would look for maxi max. Maxi max means always read it right to left. You will never have a problem in understanding this. Wait, I'll make it more legitimate. Maxi max means what? You will read it right to left. That you would go for maximum returns under each order size and go for that order size that gives the maximum of the maximum return. Okay. Now, if you look here, let me just do it with the color. If I do it here, for a risk taker, for order size 20, what is the maximum return? 10. You can choose any. For order size 40, what is the maximum return? 35. For order size 60, what is the maximum return? 42. What is the maximum of the maximum? 42. So he would go for order size 60. Now let's go ahead with B. He is a risk averse person. Risk averse person means he would go for maxi min. Why? Again, read it right to left. When I read it right to left, it shows me minimum return. Minimum return, please highlight under each order size. So I will take the new color and I will highlight the minimum return. Minimum return for 20 is same 10. You can choose any. Okay, you can choose any because the order size remains same. So let's say I choose 10 here. It is not visible. 10. Now, in the order size 40, what is the minimum return? 25. In order size 60, what is the minimum return? 15. So as a risk averse person, he would like to maximize his minimum return. Minimum return is maximized for order size 40 because out of the minimum options, it's the maximum one. Correct. So I would go ahead with order size. Clear. Now I take up C1, which is minimax regret. For minimax regret, you need to create always a regret table. I know students ask me, ma'am, it's very difficult to create a regret table. Never. Go opposite. Because regrets are always checked for every situation. We don't do it order-wise. We do final answering order-wise. But regret, we will always prepare opposite way for different situations. So here I am preparing the regret table. Okay, this is the regret table. This is the order size 20, 40, 60, demand 20, 40, 60. I hope it is very, very clearly visible, right? Now, when I see the demand, now please look here how we are preparing the regret. Regret means simply, boss, I have a regret of not taking the best profit option. So what is the regret that we will have? Not see, if you will always take it from this way, then because I'm answering it vertically, so I will do it regret horizontally. I will check if I'm not going ahead in the demand of 20 orders, if I don't go ahead with 25 as the maximum payoff, then if I go ahead with 20 only order supply, I'm just having 10 as the profit, right? I'm losing 15. So what you're losing 15, 15 becomes your regret. And here if you go for order size 40 only, there is no regret because you will get maximum profit of 25. If you go ahead with order size 60, you have a regret of 10 because 15 you are getting, 10 you are losing from the best alternative. Okay, you will always check your position from the best alternative point of view. Now if you go ahead with 40 order size, 40 is the demand, then in that case if you go for 20 order size, which is the best option to go ahead with this? Always highlight the best one. Now what is the regret here? 28. What is the regret here? 3. And what is the regret here? 0. Now here what is the regret in the demand for 60 order size? You will always go with the maximum 42. So here the regret is 32. Here the regret is 7. Here the regret is 0. Now what you have to do is, we are doing it as per mini max regret. Please read it from right to left and you will never have a problem in the exam. So first see maximum regret. Okay, first see maximum regret. Select the, from every order size, select the maximum regret. For order size 20, what is the maximum regret that we have? I will have the maximum regret of 32. For order size 40, the maximum regret is 7. For order size 60, the maximum regret is 10. Now, of course, being the risk neutral person, this is the risk neutral person. He would always like to balance himself. That means he would go for that option that minimizes his maximum regret. So look, here we write minimum. Minimize the maximum regret. Which of the three is the minimum of all the maximum regrets? The minimum is 10. So therefore he would go for order size 40. Okay, I hope I'm very clear here. Okay. Any questions, any queries, guys? Are we clear? Just please respond back in the chat box. Last topic that I'm taking from risk and uncertainties is yes, you were correct, Anjali. I'm sorry, I saw your answer just now. Okay. So next topic that we're taking from risk and uncertainties is sensitivity analysis. Sensitivity analysis is simple. You just have to see what if. So here I'm giving you the technique to handle uncertainty, which is sensitivity analysis. That simple answers your question, what if? What if there is a change in the input variable, and due to that change, what is the effect on the output? So typically we always see the relationship with sales. With sales we always see. Okay, understand which is the input variable due to which the output is most affected. That is very sensitive. It means what? That a little change in the input variable will bring change in the output variable. Like for example, the question says that a 20% change in advertisement cost, the 20% change in advertisement cost will bring change in the sales. Or the question says a 10% change in the labor cost will bring a change in the sales. So the sales is more sensitive to which product? To which option? Labor. Why? Because a small change in labor, only 10% change will change the sales. But a 20% change in advertisement will change the same. So sensitivity is always towards the labor more. So in your exam questions, the most sensitive is the product where the percentage is lowest, because lowest percentage will bring a change in the sales, for example. Clear? Make this absolutely crystal clear. Done? Few points to remember, and this helps the manager in decision making. Few points to remember. Number one, the variable, the change of which is resulting in the change of output with the lowest percentage is the most sensitive variable for the output, as a small percentage can lead to a change in the output, and thereby decision is compared to other variables. So thereby the decision will also change as compared to other variables. Clear? Done. So we're done with this chapter as well. Now let's go to the last topic of your syllabus that we are going to cover today for PM revisions is quantitative analysis. Okay, I hope now also your energy levels are super duper high, just like me. Guys, enjoying the PM sessions? They're like boring. Tell me in the chat box. Interesting or boring? Do let me know in the chat box. Do let me know. Okay. Okay, now let's proceed to the last one. Okay, now the last one let's take up, which is quantitative analysis. Now, there are some quantitative techniques. Thank you so much, Anjali. There are some quantitative techniques which are really, really helpful. And where do they help you in? They help the managers in doing the forecasting, in doing the budgets. So they are really, really helpful there. So remember that quantitative techniques help the managers in doing budgets, in preparing the budgets, in doing the forecasting, preparing the estimations. Clear? Now, first method that we understand here is high-low method in the cost accounting is the first quantitative technique. First, and the high-low method basically does, it identifies the high and the low points wherein we take it in quantities or hours. Okay, always we do high-low method with an approach from quantitative, we always take step one, take the highest and the lowest level of quantities, be it units or hours. Number two, calculate the variable cost per unit. You'll take the difference in the cost and difference in the units. And by this you get variable cost per unit. We know variable cost is constant. Put it in any of the highest level equation or lowest level equation and get the fixed cost. So finally you will get your fixed cost. When you get the fixed cost, you put it now fixed cost and variable cost in the equation, in the total cost equation. Total cost equation is variable cost per unit multiplied by the number of units plus fixed cost. When you put it in the equation now, you can calculate the total cost for any of the unit levels which is given to you. You just have to multiply units with variable cost because fixed cost is fixed, and this is an assumption that we can. Okay, that's all. Now let's go to the next one. The next quantitative technique that we will understand is a correlation coefficient. Very, very important. The formula here, this formula will be given to you in the exam. No need to learn it. But first understand the background. That what do we understand in correlation coefficient? So when we see understanding the correlation, here please see the focus is to identify the relationship between the two variables. That is, okay, we understand here the relationship between the two variables, that is the change in one variable okay brings how much change in one variable brings the change in the other variable. Okay, so basically what we are doing here is we are creating a relationship between output levels and the cost at that level. Okay. For example, what? I'll just explain you here. For example, that you're looking into, so you're finding a relationship between the two variables, like advertisement and sales, like the output and the cost. That basically we try to see that, okay, if there is a change in the cost, how much change it is going to bring in the output. We are not calculating the percentage here. We are saying that will it really bring a change in the output? If I change my cost, will it really bring a change in the output? No, if my cost goes up, will my output go up? If yes, it's a positive correlation. My cost goes down, my output goes down, it's a positive correlation, same direction. My cost goes up, but when my cost goes up, my output goes down. Negative correlation, opposite correlated. Clear? So, and correlation is always measured where the value of R is always between 0 and 1. Oh, sorry. Value of R is always between -1 and +1. Where -1 would mean, typically that it is a negative correlation, and if it is R is equal to -1, it would typically mean perfectly negative correlation. What do I mean by perfectly negative correlation? Perfectly negative correlation would mean that, let's say your labor cost is going up by 20%, your sales are also going down by exact 20%. So perfectly negative correlation. R is equal to +1 would mean that it's a perfectly positive correlation. That means if my cost is going up by 10%, my output is also going by 10% only. Exactly the same lines. So it is a perfectly negative positive correlation. R is equal to 0, there is no correlation. That maybe my labor is sometimes going up, down, zigzag, and output is also going zigzag, not in any particular pattern. Clear? Done. How would you find out R? And R is also known as coefficient of correlation. So x is one variable, y is another variable. You will take the sum of x. No, the formula is sum of xy. Just a minute. No, the formula here is wrong. Wait, I'll correct it. Just a minute. I'll just do the correction. Just a minute. Excuse me. Yeah, I'll just draw down the formula. So it is equal to just give me a minute. Actually, it is not wrong. The way of presenting it is wrong. So I will just write down the correct formula. Okay, now here R is equal to N multiplied by sum of xy less sum of x multiplied by sum of x multiplied by sum of y divided by square root of n multiplied by sum of x square less sum of x whole square. Okay, and this we will multiply with n multiplied with sum of y square less sum of y whole square. Done? Clear? Right? So please use this formula. X and y are the variables. N multiplied by sum of xy, that is you will do x and y and get the sum of it. Less sum of x, sum of y and divided by this. So just use this formula and get the value of r. What is important for you is to do interpretation. Okay, but what is important for you is to do interpretation. So just understand one thing which is very important here, that what is the role of R. R is not telling you what is the percentage of the correlation between the two. They are just telling you that whether the two variables are correlated or not. So R is just a measure of correlation, that's all. Okay, R, what is R doing? I will just explain it here. R would measure the correlation between the two variables. So now you know if R is positive, it means the two variables are going in the same direction. If R is negative, they are going in the opposite directions. Clear? And the range of R, please understand, it will always be between -1 to +1. Don't make that mistake of taking it other ways. Now you know what is perfect positive, perfect negative correlation and no correlation at. Now I take up the next one, which is coefficient of determination. Coefficient of determination. It is represented by R square. Okay, now understand what does coefficient of determination tells you. Coefficient of determination tells us that it would simply measure the proportion of change in one variable as a result of change in another variable. Okay, now please understand R square is always positive. So R square value will always fall between 0 to 1. Okay, clear? Now R square gives you the percentage. It simply says, okay, let's say that the change in one variable is giving the other change in the other variable by 40%. So now we know the percentage. Percentage is determined by determination. Correlation coefficient just tells us that whether the two variables are correlated or not. Simple. Done. Let's go to the next one, regression analysis. Regression analysis uses the basic cost equation where a is equal to y is equal to a plus bx. Okay, why do we do a regression analysis? Again, just like the normally, why do you do a correlation coefficient? We simply make predictions and make future estimates with it. We try to see here what is the relationship between the two variables. Okay, typically what is the effect of change in one variable will give an effect on the other variable. Okay, now here the formula is correctly written. A is equal to sum of y by n less b multiplied by sum of x by n. Again, this formula will be given to you in the exam. No need to memorize it, but you have to know how to use it. Okay, in the questions. B is equal to n multiplied by sum of xy less sum of x by multiplied with sum of y divided by n x sum of x square less sum of x whole square. Okay, so this is a formula that you will use to calculate A and B. Once you know A and B, you know the number of units you can get Y. Okay, so it helps in decision making. Now there is a term used which is called as interpolation and extrapolation. So what is interpolation and extrapolation? That simply says, see, if there is a particular data range within which you are finding out the values. Let's see, my data range is the height of girls from 1 year to 20 years. Okay, now if I want to find out what is the height for an 18-year-old girl, it is within the data range on the basis of which I've created the equation. So of course I will get more accurate answer, and that is known as interpolation. When you're finding out the value for a data which is within the data range based on which you have calculated the A and B and draw down the equation. Now I want to know what is the average height for a girl aged maybe 45 years. Okay, like for example, so then in that case I may not get the correct answer. Or what is the weight? Let's not talk about height, let's talk about weight. What is the weight for a girl aged at approximately 45 years? I will not get the correct answer. Why? Because my data range was there till 20 only, and I did not consider any other factors when I'm doing for 45 years, like age and maybe other factors can come in picture. So that I'm not considering here, correct? So therefore extrapolation will help in will help in forecasting, but it will not give you accurate data always, because not all factors are considered and this data is outside the data range. Done? Okay. Next is time series analysis. Time series analysis simply says that how would you calculate your forecasted data. So forecasted figure. Forecasted figure will be equal to your trend. Okay, take the effect of trend. Okay, it is given here. Wait. I'm sorry. So it simply says, boss, when you're doing the forecasting for the data, please understand that whatever you are making the predictions based on your past trends, you make the predictions, you will have to take the effect of seasonal variation. You'll have to take the effect of cyclical variations and random. Cyclical and random are not there for calculation purposes in your syllabus. Seasonal variation is there, which means that let's say I sell my clothes in the summer season, so I will have some effect in the winter season also, right? My sales will not be same like summer. So that is what we have to consider here when you're doing the predictions. It simply says average out the variations. Okay, so that you have almost average sales that you calculate for the forecasting, and that will help you do the forecasting in a better way. Okay, let's calculate the quarter wise average and then take the effect of that quarter wise seasonal variation for the quarter that you're predicting, maybe after 4 years, after 5 years. We assume that the same seasonal variations of the 4 quarters will continue for the future years. Now this is an assumption that we can. So here we have two models to account for it. One is an additive model, next is a multiplicative model. Additive model simply says that you add the trend and the seasonal variation. Here I'm not considering because these are not there in your syllabus. Okay, so time series basically means forecasted data. So when you want to forecast for a future, your forecasted data will be equal to time trend plus seasonal variation or minus seasonal variation, whatever it is. and time trend multiplied by seasonal variation if you're doing a multiplicative model. Simple. Okay, now few things that you have to note here is, ma'am, how do we do this trend? How do we calculate trend? So trends you will understand. We will work out trend by using the moving average method. Moving average method means what? That let's say you have an year data, 1, 2, 3, no, you have a quarter data. Okay, let's take year only, 3, 4, 5, 6, 7. And I say that we have a 3-year moving average. 3-year moving average means now here I've got the sales total. Sales total is 100, 200, 50, 200, 100, 120 and 80. Okay, now what you will do here is get the moving average totals. Moving average total means what? That get the total for the 3 years, because I am saying that my moving average is 3 years. So get the 3 years data and total it, and always write it in the middle. Always. So 200, 350 I have. Again here I will get and write it in the middle here. I'm sorry. So here my middle will be this figure. It will be 450. Let's take the next one, and I will take here. Here I will get 350. The next one, and I will get here 420. Then the next one, the last one, which is 100, 200, 300. Why last? Because I don't have the 3 years after it. So I will not take it. Now you get the moving average. How would you take the average? This is the total for 3 years. Divide by 3 and get the average. So divide by 3. You will get the figure here. This is the figure that you will take as trend, and on this trend you will adjust the seasonal variation. Clear? Now seasonal variation point, when it comes the next point that requires sometimes adjustment of seasonal variation. So understand that when we follow additive model, the total of seasonal variation for a year should be equal to 0. Okay, that means let's say your seasonal variation has got 4 quarters, quarter 1, quarter 2, quarter 3 and quarter 4. Seasonal variation here is 0.2, here it is 0.5, here it is 0.3 and here it is negative 0.5. Okay, negative 0.5. Now when you take the adjustment here, you can see the total here is coming as 0.5. Since the total is coming as 0.5, it's not equal to 0. You need to make it equal to 0. How would you make it the equal to 0? Less 0.5. And here accordingly you will distribute it equally all 4 quarters. So 0.5 divided by 4 gives me 0.125. From every quarter I will reduce 0.125, 0.125 and 0.125. Now when you get the total, this is your revised seasonal variation that you will use for your additive model. Clear? So quarter 1 revised seasonal variation will be 2 minus 0.125. Likewise for quarter 2, quarter 3, quarter 4. When you follow multiplicative model, the total of seasonal variations in the year should be depending upon the number, what period you are taking. Let's say I am taking the period as quarter. So then the total of seasonal variation should be 4, because there are 4 quarters in a year. Let's say I am taking the number of periods to be months. So my total of seasonal variations total should be 12. Like this you will do it. Clear? Absolutely clear. Trend analysis. Don't make a mistake in the exam. Now this is the last pointer that we have, that is learning curve. Learning curve is very, very important for the exam purposes. Okay, and why? I'll tell you here. Let's just take learning curve here. I'll just be there in 1 minute. Sorry guys. Okay, now let's understand the learning curve. Last pointer. So all of you, please be with me. The most important topic, learning curve analysis. Here, learning curve means what? It simply states that look, if I am doing the first time a particular job and I take 10 hours for it, the next time when you do the same job, of course you will take the less time. What is that percentage of reduction? That is learning curve percentage. Simple, clear. So calculate that percentage. What percentage is your time saved? Let's say I say, now we measure learning curve by two approaches. One is the tabular approach, next is the algebraic approach. As tabular approach is, for example, and it is only applicable to doubling units. So let's take an example here. Okay, the example is let's say my first unit, then double 2, then double 4, 8, 16, likewise only it will be applicable. It will not apply to, if you ask me, ma'am, what is the learning curve or what is the learning, what is the time taken to produce 3 units? I don't know because tabular approach does not give me this answer. But with algebraic approach, we can do it. So as per tabular approach, let's see what is the time taken and what is the time taken to make the first unit, 100 hours. Let's say I take that the learning rate is 90%. It means the cumulative average time. We use the term cumulative average time. Cumulative average time to make the second unit will reduce by 90%, will be 90% of the previous time. So 100 multiplied by 90% gives me 90. Likewise, when I make the fourth unit, okay, when we make fourth unit, the cumulative average time will be 90 multiplied by 90%, which is 81. Again, the eighth unit, when you make, the cumulative average time will be 81 into 90%, which is 72.9 hours. And again, when you make the 16th unit, then the cumulative average time will be 72.9 multiplied by 90%, which is 65.61. Done. This is the hours. Cumulative average time means average time to make the 16th unit. Average time. So if you have to take the total time, you simply have to multiply hours with the cumulative hours with the number of units. First unit total time will be 100 hours. Second time, when you make 2 units, now the total time is 180 hours. When you make 4 units, the total time is 81 into 4, which is 324 hours. When you make the 8th unit, when you make total 8 units, the total time to make 8 units will be 72.9 multiplied by 8. 5,583.2 hours to make total 8 units. The total time to make total 16 units will be 16 multiplied by 65.61. 65.61 is your cumulative average time. So here it will give me 1049.76 hours. Done. This is your tabular approach that helps me to calculate the total time, cumulative average time. Question will ask you what is the total cost. So then total time multiplied by labor cost per hour, you will get the total cost to make 8 units, 16 units and so on. Now, if I need to know what is the time taken to make the third unit, to fifth unit, seventh unit, then I will not be able to do it with tabular approach. So then we use algebraic approach. Algebraic approach takes the formula and that says y is equal to a multiplied by x to the power b. Now what is y? Y here is cumulative average time. X is equal to number of units. Like I want to know for the 3 units, then I will multiply x as 3. And b is equal to log of learning rate by log of 2. How would you find out logs in the exam? In case if you're just carrying this calculator, then for that please follow my YouTube video. I've uploaded how to use on-screen calculator and use logs over there. So please look into my shorts and you will find it. I will also upload the link in the description box. Now, what is by cumulative average time? So with this, when you solve it, A is the A I have not given. A is the time taken for the first unit. Okay, what is the time taken when you make the first unit? That is A. So A you will have with the log tables you will be able to calculate B. Then you can calculate the value of X as well. How to calculate value of X also using the scientific calculator you will find in the same video. Now A is the time taken to make the first unit. Clear? When you solve this you will get the cumulative average time to, let's say, make 3 units. Now multiply it with number of units, which is 3, to get the total time to make the 3 units. Likewise, you will calculate the total time to make 2 units. Why? Because when you reduce the 2 total time to make 3 units less total time to make 2 units, you will get the time taken to make the third unit, which is desired in the question. Clear? So this is how you will be doing the question in the exam. Now, in order to know, ma'am, how to solve these kind of learning curve questions, again, section A and B marathon, I have taken specifically a lot of questions for learning curve. Please go and watch the video and look at the questions over there. Okay, so that's all for the topics that I'm taking for today. And these topics we have covered today. Let me show you the list of the topics that we covered today. We covered throughput accounting, environmental and sustainability, target and life cycle costing, relevant costing, limiting factor analysis, pricing decisions, risk and uncertainty, and quantitative analysis, as well as CVP. Tomorrow we are going to be covering these remaining topics. So you have to join on time, subscribe to my channel, and I would really appreciate and look forward if you can give me a feedback on how these revision sessions are helpful to you, and give me a feedback on the session that you have, so that it is encouraging, and share it with a lot of your friends so that you all join tomorrow at 11:30 a.m. where we will cover these remaining topics live in the class for your PM revisions for your exam attempt. So do well, study well, and just like the channel, like the video, subscribe to my channel, and look for all the videos. Guys, please go through your section A and B marathon session also. Very helpful. In my playlist of PM, even you will find a lot of other videos which are very helpful also. And if you need anything special for tomorrow, ma'am, this topic, please just add on few points more. Type it in the chat box and I will consider it. Okay, and I've also given a mock on my Telegram channel, which I will evaluate free for everybody who's appearing for that mock. So to join the channel, the link is already there in my description box. Don't forget to join my Telegram channel and appear for the mock over there. So till that time, goodbye, take care. See you tomorrow live at 11:30 a.m. Don't miss out on it. Thank you so much, guys, and see you tomorrow. Bye-bye.